Okay. So if you come to the standards, what you have to know for the standards is that it should be able to be abreast with what? With the non-current asset standards. If I say non-current asset standards, what do I mean by non-current asset standards? Those standards relating to PPE. Okay, so you have the PPE self, investment property, impairment, non-current asset held for sale, leases, those at least it should be able to be on top of those standards. Okay, those days they have been examining at least 3 of the non-current asset standards, but now it's not like that. They're just setting the question anyhow. But at least you have to be okay with all of them. So I'm not going to tell you that this is a standard that will come. Anything can happen. So we try our best to solve one questions on each of these standards. So we are going to be starting with financial instruments. Then we come to what? We come to tangible. We solve it in that particular order, at least one of them. So just pick the just
Question 1.
Question number 1 first. Yeah.
Okay, so question number 1. On 1st January 2021, WL issued 12.5 million bonds of 100 cedis each for 1,250 million Ghana cedis. The related transaction cost on issuance amounted to 50 million Ghana cedis. Each bond is convertible on 31st December 2024 into 2 ordinary shares at the option of bondholders. Any unconverted bond will be redeemed at the date at par value. Under the terms of the bond, there is no interest on bond for 2021 and 2022. However, interest is payable at 16% per annum on 31st December 2023 and 2024. On the date of issue, market interest rates for similar debts without conversion option was 12% per annum, payable each year. However, on account of transaction costs incurred on issuance of bonds, the effective interest rate would increase to 13.2% per annum. In the financial statements, the proceeds have been recorded as convertible bond, classified under equity, and the transaction cost has been expensed out, required, in line with IAS 32 financial instruments, presentation, and then IFRS 9 financial instruments, set out and discuss the accounting treatment of the above issued bonds within WL's financial statements for the year ended 31st December 2021.
All right, thank you. So this is about what? Convertible what? This is about convertible instruments. Okay. So convertible instrument, how do we account for it? Initially, how do we go about it? This is a financial instrument, please. You should be okay with what? Financial instrument that is going to be debt instruments where we have financial liability, okay, and also the financial assets. So we have done the financial liability, but we haven't done the financial assets, okay. That one, don't worry about that one, okay. So this is a convertible instrument. We have done a convertible instrument, okay. Sometimes the question will give you, they will give you shares that they say the company has issued shares, okay. The company has issued shares. Then they will say that each share is convertible to this amount, this amount. Just know that that is a convertible instrument. So for convertible instruments, what we have to do is that we find the debt component and also the equity component. We split it at the date of the issuing the instrument. We split the two between debt and equity. Okay. How do we do this? Okay. The debt will always be the present value of the cash flows discounted as what? Discounted at the rate of a similar instrument without what? Without conversion. So this is how we are going to be doing. So let's come to that question number 1 there. Okay. So this is a convertible instrument. Mostly, if you want to see a question, it might be on a convertible instrument or financial asset or financial liability. Okay. So we do the convertible instrument. So at the date of issuance, we have January 2020. Okay. So we do the splitting between debt and equity. So we come to the debt component here. So we have the debt component. So what is the option to convert and what is the debt? So it's a convertible. It's an instrument that is having both equity and liability. So you have to split the two. So what would be the debt? The debt is always the what? The present value of the cash flows under the instrument discounted at what? A rate, interest rate of a similar bond without what? Conversion. Okay. So what we do over here is we have years cash flow. Then we have the discount factor. Then we have the present value. Okay. Please, can you hear me?
Yes, sir.
Yes, boss.
Okay.
Yes, sir.
Okay. All right. So the cash flows under the debt, the cash flows under the debt is the interest that we are going to be paying. The interest is the coupon. So what is the interest that we are paying? The question is telling us that under the terms of the bond, there is no interest on bond for 2021 and 2022. So when are we going to start paying the interest? When will the entity start paying the interest?
2023.
31st December 2023.
Yeah, when will the entity start paying the interest?
December 2023.
December
Okay.
2023.
That will be how many years from now?
3 years.
Okay. So the interest will be paid from December 2023 and December 2024. And December 2024, we are going to be paying the money back to them. Okay. So let's come here. What will be the interest? What will be the interest payment every year? What will be the interest payment every year? What will be the interest payment every? What will be the interest payment?
%16%.
16%.
15% on what figure?
On the nominal value, yes, 1250 million.
On
1250 million.
okay, how much are you getting?
200.
Okay, so the interest will be the nominal interest of 1.06 multiplied by the nominal value, which is the value of the coupon or the face value. That will give us 200 million. So we start paying 200 million from 2023. 2024, we will still pay the 200 million together with what? We will pay the 200 million together with what?
The principal.
So the total payment will give us what? It will be
1450.
So the 2024, we are going to be redeeming the what? We are going to be redeeming the instrument at par and also paying the interest in that particular year. So that will give us 1450. Okay. So let's come to the discount factor now. Okay. You can equally do this like this. Okay. If you don't want to confuse yourself, then you can have something like this. 20, we are issuing the instruments on what?
2021.
Okay. So at the end of 2021, there will not be any interest payments, isn't it?
Yes, sir.
2022, there will not be any interest payment. So you come to 2023 over here, we are paying 200. I hope that is correct.
Yes, sir.
2024, we pay the 200 together with the principal. We have after the 4 years, we are going to redeem the what? The instrument at par. We do this as if the conversion is not possible. We do this, we are looking for the value of the debt. So what would be the value of the same instrument? What would be the value of the same instrument for somebody who is not having a conversion? That's what we do. So we come to this one, we have the 200 over here. So at the end of this year, we pay the interest and still pay the amount to these people, and that will give us 1450. The full amount is 1,250 plus the what? The interest, that will give us what? 1450. So let's come here. Our interest rate will be 12%. We use the rate of similar bond without what? Without conversion. And that will give us 12%. Okay. That will give us 12%. Then what are we having? What is the discount factor for the first year? What is the discount factor?
0.8929.
Okay. 0. I'm doing this. I can just stand up and do only 2 years. I'm doing because so that then we will not be what? We will not be having issues with how we are doing this one. So 0.8.
8929.
Okay, 893. The second year is what?
0.797.
0.79.
72.
Okay. The third year is what?
0.712.
0.712. And the fourth year will give us what?
0.636.
So 0.636. Okay, so what are the figures that we are having?
The last year is 922.2.
922.2. Okay.
2023 is 142.4.
142.4. The total will give us what?
1064.6.
1064.6. So that is a debt value. What would be the equity component? What would be the equity component?
So we take this out from the bond value.
And that will give us how much?
185.4.
185 what?
0.4.
0.4. Okay. 185.4. Okay. So at the initial recognition, this is what we do.
Hello, sir.
Yes, please.
Sir, please, the discount factor, is it the same as the 1 divided by 1 plus 0.12?
Yes, please.
Okay, since I'm not getting it, that is why I'm asking.
What are you getting?
The first one, I got 1.
You got what?
1.
What are you using? Are you using the 0?
Yes, sir.
How?
For the 2021 that I'm talking about.
2021 is first year. That is year 1. The exponent is the year, not the number, not the cash flow.
Oh, okay. Thank you.
I hope you have a sister.
Yes, I have it now. Thank you.
Okay. So initial recognition, this is what we do. So at the date of the issuance, we actually separate these two. Okay. So you'll be having debt
Hello, sir.
component.
Please, can you go through the equity component for me? How you got 185?
One what?
185.4.
185.4.
How we got 185.4?
Charles,
Sir,
I know
he's
that.
asking of the equity component.
Yeah, who mentioned the 185.4?
Sir, please, I did.
So how did you get it?
Okay, so the equity component of any convertible instrument is the difference between the nominal value and then the present value of the cash flows arising from this instrument.
So how did
So
you get?
we had
Okay.
so 1250 was the nominal value of this instrument, and the present value of this instrument was 1064.6. We just take it out from the 1250, and we have the 185.4.
Okay. Erico.
Hello, sir.
Yeah.
Okay, I'm okay. Thank you
Yeah.
very
Okay
much.
now. Okay. Oh.
Yeah.
All right. So let's move on now. Okay. So we have our debt component. So what we do is at the transaction date, we have our debt component to be the present value of all the cash flows. That will be 1064.6. And we have the equity component to be 185.4. Okay. So we have the subsequent measure, or no? We have issuing cost there, isn't it? The transaction cost. I hope there's a transaction
Yes,
cost.
sir.
Yes, sir.
Okay.
50 million.
So how do we treat the transaction cost? This is relating to what? Instrument that will be there for more than what? More than a year. So we capitalize it. But how do we account for the transaction cost? Charles, what did I say about the transaction cost the last time?
So I wasn't in class the last time.
So what are you going to do if you see this question?
So we capitalize it and amortize it over the years.
You say you are not in class. Now you are using we.
Hey, sorry, sir.
Okay. So if you are not in class after the lecture, why can't you go and watch the video? Or you think that you like this thing Madam Kofa has taught you, or they have taught you these things. The one that they have taught you just some surface of it. Okay. How do you treat the transaction cost? Okay. So yes, you have done financial instrument, fine, but not all of them that you have done. Okay. So look for the ones that you haven't done. But if you are having that, oh, I have done this in school, I've done this in school, just it over you. Okay. How do we treat the transaction cost if it is relating to what you, yeah, senior?
Yeah, I think we share it to them with their ratios.
In their what?
With their ratio, with their ratios.
So we share to equity and then the debt
And then the debt component using their respective figures.
Okay, using their respective carrying values. Charles, that is how we do it. This is not for one instrument. If it is two instruments, you share it among the two instruments based on their carrying values. So the transaction cost, we come to the transaction cost for the debt component. Transaction cost for the debt component. You have, okay, but if you have discount, please, you take the discount from this figure before you find the debt one. So the discount will be adjusted against the full amount, which is the 1250. If we are issuing discount, it means that we are going to be taking a discount from this one. Discount we don't share. It's only the transaction cost that we share. So we have the transaction cost. That will be 1064.6 divided by 1250 multiplied by 15 million. I hope that is correct. Okay. Equity component. Equity component will give us 185.4 divided by 250 multiplied by 50 million. What are we having for the debt? What figure are we having for the debt?
42.58.
42.58. Okay. And this one will give us what?
7.42.
7.42. So what we do is that we capitalize this cost. Capitalizing means that we what? We debit it to whatever account that we're supposed to debit it to. So you come here, your debt component will now be, okay, the net figure for the debt component will be the purchase price or whatever amount, or let's say the fair value. Let me just use this fair value. Okay, let me use fair value for the debt component, fair value. That will give us the what? The 1064.6, isn't it? Then transaction cost will now be capitalized. Capitalizing means that we subtract, and that will give us 42.58. What are we going to be having?
$1022.02.
1022.
22.02.
Okay, so this will be the figure that we have. So what we do is we now calculate finance cost. Okay, so the finance cost is now what? Okay, let's come here. What is the rate that we are going to be using to calculate the finance cost?
13.2. The discount factor rate.
That is what?
13.2.
We use what? 13 point what?
13.2.
Okay. We should have been using 12%, but because of the transaction cost,
Transaction cost, yeah.
the effective interest rate has increased to 13.2. So use 13.2 to now what? To now account for this. We have taken our time to explain why we use the effective interest rate. So that will be 0.132 multiplied by the net amount. That is what? 1022 point what? 02. What are we having?
134.91.
134.91. Okay. So is there going to be any payment of coupon? Is there going to be any payment of coupon this year? Okay.
No.
So what will be our final figure?
Um, 1156.93.
1156.93. So you come to your statement of profit or loss. You have your finance cost of 134.91. Statement of financial position. You have your liabilities here. Then you have your convertible bond. Your convertible bond to be 1156.93. Then you come to your equity. The equity, you have other components of equity to be 185.4 minus what is the transaction cost?
7.42.
Okay, 7.42. Please, this will be taken from the equity figure. Equity is having a credit balance. So if you are debiting the cost, that will be reducing the equity. What are we having?
177.98.
Okay. 177 point what?
0.98.
Okay. Please, this is how we go about a convertible instrument. Convertible instrument is having equity and liability. So at the date of at the date of issuing this particular instrument, you separate the equity from the liability. How do you separate it? You ask yourself, what would have been the value of the same instrument without conversion? Or let's have a different company issuing this particular instrument without conversion. What is the value? What is their market value? Then you determine that particular market value, just like finding a value of what? A value of a debt under financial instrument, finding a value of a debt. You present value the cash flows relating to the debt using the internal rate of return. Okay, so we find that one, then we find the difference between what? The debt figure, the cash flow of the present value of the cash flows. We compare with the total amount that we are receiving. The difference is what? The difference is the equity or the option to convert, which will always be taken to other components of equity. If there's any transaction cost, you share the transaction cost to them based on their what? Based on their carrying values. The carrying value means the value that you have shared among them. You share the what? The transaction cost. The transaction cost is capitalized. These are all treated as debt instruments. Transaction cost is an expense. Capitalizing means that you are going to be debiting. If you are debiting equity account, it means that you are reducing the equity. If you are debiting liability account, it means that you are reducing the liability. So we subtract the transaction cost from each of them. Then the debt, you amortize it. We have shown how to amortize this one when we are doing financial instruments. So this is the time to solve questions. Okay, this is not the time to calm my pitch in general. No, that is all about a convertible instrument. You might see question on financial instrument. You need to be very smart. Even final account, they can give you question on financial instrument, convertible instrument, or financial liability, or sometimes they can give it to you on what? Preference shares, redeemable preference shares. You say that redeemable preference shares are treated as debt instruments. So they can give you a question on that. You just have to be very open to adjust it. We are done with financial instruments. Just intangible assets.
Okay, so IAS 38, Intangible Assets. On 1st April 2017, VL acquired a license for operating a TV channel for 86.3 million Ghana cedis, out of which 50 million was paid immediately. The balance amount is payable on 1st April 2019. A mega social media and print media campaign was launched to promote the channel at a cost of 10 million Ghana cedis. The transmission of the channel started on 1st August 2017. The license is valid for 5 years, but is renewable every 5 years at a cost of 35 million Ghana cedis. Since the renewal cost is significant, the management intends to renew the license only once and sell it at the end of 8 years. In the absence of any active market, the management has estimated that residual value of the license will be 15 million and 20 million at the end of 5 years and 8 years respectively. Applicable discount rate is 10% per annum. So required, discuss how these transactions should be recorded in ZL's books of accounts for the year ended 31st December 2017.
Okay, we have solved this question in class. So someone should take us through how to solve it. What do we do? What do we do at the transaction date on 1st April? What do we do? On 1st April, what do we do?
So on 1st April, we paid part of the 86.3 million, which was 50. The remaining was to be paid, I think, 2 years later, because from 2017 to 2019 is 2 years. So we will have to find the present value of that future payment and add it to the present 50 million we've paid. And that will be the purchase consideration for this TV channel we've purchased.
Okay. What will be the
next?
Yeah.
The next issue over there they spoke about was the sentence talking about the advertising cost or the social media campaign of 10 million. We said that this advertising cost is not whether we have this, whether we incur this transaction cost or not, whether we incur this advertisement cost or not, it does not add value to the TV channel we are operating. So we expense this 10 million, we don't add it to the cost of this intangible asset.
Okay. So 31 December, what will happen?
So since we have an amount of money to pay, from the initial amount of 86.3 million, we have a finance cost we'll have to settle at the end of every year. So at the end of every year, as we amortize this intangible assets, we make payments or we incur finance costs. And then in the statements of financial position, we just amortize this these assets. And then
over how many years?
Please, were you saying something?
Over how many years? Amortize over how many years?
5 years.
Why 5 years? Why 5 years? Why 5 years?
So we have the issue of the renewal over there. If the renewal cost forms a significant part of the cost of the assets, the management will not intend to renew it. So since there is no renewal, we'll have it in our books that this asset is going to last for 5 years with us, and then we just sell it at the end of 5 years.
Okay. That is not bad, but at least it's a nice attempt. Maybe if you go back again, maybe you might revise before the exam time. So you will do something. Okay. So let's come here. The entity has acquired the license to operate a TV channel for what? For 86.3 million, out of which 50 million was paid immediately. Okay. So we are buying this for 86.3 million. We are paying 50 million immediately. Okay. What is happening to the remaining one? The balance is payable on 1st April 2019. That is 2 years after the acquisition. All things being equal, okay, you are what? You are going to be paying 50 million now, and the remaining 36.3 will be paid in 2 years' time. Okay. The remaining 36.3 in 2 years' time. Please, if you're having cash now, are you going to be paying the same amount, all things being equal? If you have cash now to pay the supplier, are you going to be paying the same 36.3 million?
No.
No. So it means that there's a financing component over here. Since you are going to be keeping someone's money for 2 years, the person is adding a portion of what? A portion of interest to cover what we call time value of money. So you can see that the time difference between the transaction date and then the settlement date is what? Is very big. The difference over there is what? Is significant, 2 years. That should tell you that this particular transaction is having a what? Is having a significant financing component. So it means that if we should have money today, we cannot pay the 36 point this one. So this is having issue of what? Of financing component. So with present value, this particular amount, the present value will give us a cash price of whatever we are buying. Then the remaining one will be the interest. So what we do over here is that the 1st April, okay, 1st April, that is intangible assets, IS 38, okay. So we have the 1st April. So we have the April 1, 2017. We need to determine the cost of the intangible assets. So the cost of the license. So the cost of the license will give you, we have the cash price, that is the present value. Today's value of that one is the same as that value. And that will give us 15 million. Okay, then we come to the deferred what? Payment. Deferred payment, what it means is that it's having what we call what? Financing component. So you have 1 over 1.1 exponent 2 multiplied by 36.3. If you do it very well, you'll be having 30 million.
Yes.
Okay. So you have 36.3. You'll be having 30 million. So the value of the license that we are buying is what? Is 80 million. So we are paying cash and we're supposed to pay additional cash of 30 today. But since we are not paying, the person is now charging what we call interest. Because if you give me the 30 million, I might deposited that particular amount of money in a bank and it will be giving me interest every year for 10%. But since you are going to be keeping the money, it means that I will be losing the 10% interest. So I have to charge you now at opportunity cost, which is the amount that you're supposed to pay plus the interest that amount will be given to me if I should have it. So what will happen over here is that we are going to be having a deferred payment of this amount. So this is now owing. So at the transaction date, we are going to be having a liability which will be called deferred payments. Okay. So we have deferred what? Payments. Sometimes it's better or it is proper for you to be passing the double entry so that you know what, you will not miss things. That will be 30. So the first one, the 50 will be debit the asset credit cash. That is the 50. The second one will now be debit the license credit what liability, which is the deferred payments. Let's go here. Okay. Let's come to this particular situation here. Okay. They say a mega social media print and the print media campaign was launched to promote the channel at a cost of 10 million. With or without advertising, you can still what? You can still show what movies or whatever on the channel, isn't it?
Yes, sir.
If you have a channel, you can show the channel, you can start operating the channel without creating awareness, isn't it? So the advertising is not part of the activity necessary to make or to bring the channel to the situation where we can start using it. It's not necessarily part of the activities to make the entity use the channel. No, we can use the license or we can start operating the channel, the TV channel, without advertising it. There are certain TV channels that we haven't heard about them before, but those that are present in social media are those that we have been hearing about them. They are advertising, that's what we are hearing about them. But advertising itself is not a necessary part of of operating the channel. You can operate the channel without advertising. But if they are saying that okay, the entity has now paid 2 million to change the license to its name, or the entity has now spent 2 million to create images for the television, that one is fine because we cannot start operating the channel without those images. But advertising, we can start operating the channel without advertising. So that particular cost will be treated as what? As an expense. Advertising cost is an expense. Just take it like that. So don't go there and they'll be telling you advertising cost. If the question is saying that the entity has incurred a training cost for the employees to be able to use this particular channel, please, we can operate the channel without training the employees. How? We can outsource somebody to come and operate the channel. We can go and hire somebody to come and operate the channel. You can only capitalize. You see, the training is going to be giving the entity economic benefit over time. But the issue is you don't have control over the employees. They can leave at any time. If they leave with the knowledge, the knowledge is in their head. If they leave with their knowledge. So the training cost cannot be capitalized. It cannot be added to the initial cost of the license. It cannot be capitalized also as intangible assets because you don't have control over them. And on the side of the license, you can operate the license without training the employees. So the 10 million should be taken to profit or loss straightforward. Okay, let's come here. A mega social media was this and this. The transmission of the channel started on 1st August 2017. Okay. When was the license obtained?
On 1st April 2017.
Are they giving us any information that the entity was not able to do these do's and this, so the license was available or the channel was available for transmission on 1st August? Are they saying something like that?
No, sir.
No, it means that the channel was what? The channel or the license was ready for use on 1st April. But we just decided to start operating from 1st August. The license was ready. We have the license in our name. The license is ready for what? For use. But we decided to start operating on what? On 1st August. If someone has contracted a building and everything is done, and the person has given the key to you, the useful life of the building starts from the date that the building is completed. If you want to move into the building in a year's time, it doesn't change the fact that the building will last for 5 years or 50 years. The counting of the building, the counting of the useful life starts from the date the asset is completed and ready for use. So the license is operational. You can start operating the license from what? From 1st April. they are not telling us that the entity has to change the license to their name, and that has taken what, 3 months or 4 months for them to do. If that is the case, it means that the license is not available from that particular date. But the license was available for use on 1st April. We decided to start operating from what? From 1st August. It doesn't change the fact that the time that you have the license, the license useful life start from that particular day, because there's nothing extraordinary you are going to be doing to the license. So we amortize this particular license from 1st April. But the question is, what is the useful life we are going to be using? That is a problem now. The transmission of the channel started on 1st August 2017. The license is valid for what? 5 years. Okay, that is the useful life of the license. But you can decide to renew. Okay, but it's renewable every 5 years at a cost of 35 million. Please, if they talk about issue of renewal, the determination of the useful life depends on whether the renewal cost is significant or not significant. It's a very simple logic. Okay, if I've given you a license, or if Registrar General has given you a license, okay, or the business certificate, you have obtained a business certificate at what? At 200 Ghana cedis, and they are now asking you to renew the business certificate at 150. 200 against 150. You can see that the cost is significant. If it is significant, what is the likelihood of you renewing the license? Is it possible that you are going to be renewing the license? Or the probability of you renewing the license is very low as compared to renewing? 200 against 150.
Very low, sir.
You can say that, why will I go and renew the license? I should go and do a new license. That would be better. Okay.
Yeah.
So the cost is significant. The possibility of the renewal being done is very low. So you ignore the renewals. You ignore the issue of the renewal and limit the license to its original useful life. Because this is significant. Significant means that the cost is a huge amount of money. So you are buying a license, they are asking you to renew it as a significant cost. You're not going to be renewing the license. The possibility of you renewing the license is very low. So we limit the useful life to the original useful life of the license. But if this amount should be insignificant, what does it mean to be insignificant? If the Registrar General Department is asking you to renew the business certificate at 5 cedis, are you going to renew the business certificate, or you are not going to renew it? All things being equal, 5 cedis, 200 cedis. You have obtained a certificate at 200 cedis. They are asking you to renew at 5 cedis. That is an insignificant cost. The possibility of you renewing the license is very high. So you now limit the useful life to what? To the possibility of you renewing the license. So if you are renewing the license, it means that if the question is saying that the entity wants to renew the license for just one time and the cost is insignificant, then what it means that the entity will renew the license for what? The possibility of them renewing is very high. So it means that they will use the license for the first 5 and still renew it for what? For additional 5 years. So the license will be used for 10 years. So you use the 10 years. But if the renewal cost is significant, please, the possibility of them renewing the license is very low, because the cost is very rich. It's a huge amount of money, and the possibility of you renewing is very low. So we limit the useful life of the license to what? To its original useful life. So in this case, the license useful life will be what? 5 years. You obtain it for 5 years, so you use it for 5 years, because the cost of renewal is significant. The possibility of you renewing is very low. So we use the original useful life of 5 years. So amortization of the license, will now be, so we have amortization. Amortization will be from April to December. Is that correct?
Yes, sir.
And that will be 80 divided by 5 multiplied by 9/12. Is that correct?
Yes, sir.
What are we having?
12.
Okay. So we have 12 million. What will happen? We have to amortize the deferred payment, isn't it? So we have the finance cost over here. Okay, so we have to charge interest of 0.1 on what? 30 million. How much are we having? Okay. So in the statement of profit or loss of the entity, what are we going to be having? We are going to be having amortization expense of 12 million, and we have finance cost of what? Finance cost of 3 million. In the statement of financial position of the entity, they will have non-current assets, and that will be a license, isn't it? And the license will be 80 minus 12. What are we having?
68.
And we have non-current liability, that will be deferred what? Payment, that will be 30 plus 3, that will give us 33, isn't it?
Yes, sir.
All right. So that is the issue. If the renewal cost is
Excuse me,
insignificant,
sir.
yes, please. Yeah.
The finance cost, since we started in April, do you think it should
Oh,
be?
sorry, that should be 9/12. Thank you.
Yes, sir.
So we have 9/12. What are we having?
2.5.
Okay, 2.5. So that will be 2.5 over here. And this will be 32.5, isn't it?
Sorry, 2.25. 2.25.
It's just 2.25. So we have 2.25. And that will now give us 32.
0.25.
All right, thank you. So 32.25. So if we come to license, renewal of license, the renewal cost play a major role in the determination of the useful life of the intangible asset. If the cost is insignificant, the possibility of renewal is very high. So we now use the renewal and we use the renewal to determine the useful life. So if the entity is committed to the renewal and the cost is insignificant, we add the period of the renewal to the normal useful life. We are going to be using the asset for 5 years. Then if we renew it, we still use it for additional 5 years again. That means that we are going to be using the license for 10 years. Okay, so we have the useful life to be 10 years. Please, they are saying that in the absence of in the absence of any active market, management has estimated that the residual value of the license will be 15 million and 20 million at the end of 5 years and 8 years respectively. Applicable discount rate is 10% per annum. Charles, what did we say about determining the residual value of intangible assets? Charles, what did we say about determination of residual value of intangible assets?
Right. If I remember correctly, since residual values, we don't have an active market for residual values. We can't actually have the assurance that they will be sold at the end of we using it, even though it could be valuable. Since it doesn't have an active market for it, we don't consider their residual value.
Okay. We say that intangible assets is not like tangible asset. Even if motorbike is motorbike has involved in an accident, you can still manage it. So there can be a residual value for it. But if you come to intangible asset like software, someone can just develop a new software and this one will become useless completely and nobody will be willing to buy. So we determine the residual value in relation to active market, or there's a committed buyer who is willing to pay this amount for it at the end of at the end of the period or at the end of the useful life of the intangible assets. So if you are giving residual value or you are giving revalued amount and there is no active market, please ignore. We make reference to the residual value and the revalued amount using active market, or there's a committed buyer. There is someone who is willing to purchase the intangible asset at at the end of each useful life. And there's no active market. Active market means that there is no market that we are going to be selling this in. So nobody will be willing to buy. So in the absence of no active market, the residual value should be what? Should be zero. The residual value over here is what? Is zero. All right. So the residual value there, please don't include. Know that for intangible assets, what we do is we measure residual value in relation to active market, and also if there's a committed buyer or someone who is committed to purchase the item. If there's no
Senior.
one that, yes, please.
Hello.
Yeah, I can hear you.
Yeah, please can you get to the boss for me?
Senior, can you go back for me? Me too, let me see something. Okay. Thank you, sir.
You are back.
Hello, sir.
Yes, please.
Yeah. What is the criteria to use, to determine whether the amount is significant or insignificant? What is the criteria?
The question will tell you.
My mind dropped.
The question will tell you.
Okay.
For the purpose of exam, the question will tell you.
Okay.
But if the amount is significant, at least the amount should be closer to the 100% of whatever you are going to be. The advertising cost should be expense. Sorry. So in the statement of profit or loss, the advertising cost should come here. So we have advertising cost. Okay, to be 10 million. Okay, so let's look at the renewal fee over here. Okay, we are buying the asset at 35, isn't it? We are buying the asset at 80 million, isn't it?
Yes, sir.
Yes.
And the renewal fee is what?
35.
So you can see
35
that
million.
that is up to half of the what? Of the cost. So that is significant. Are you okay? But if they should say 5 million and the question is not saying anything, you can say that the cost of renewal is insignificant because 5 million. You bought something 80 million and they're asking you to renew at 5 million. Yeah, that is insignificant. Even 15 million is still what is not. But for the purpose of exam, the question will actually state whether the cost is significant or not, because it depends on the entity. What is significant to one entity might not be for the other one.
Thank you, sir.
Okay. Okay, let me use this one. Let me solve this question. Just take the question number 2A.
Okay. Question number 2A. So should I take the preamble for the A?
Yeah. Take that one.
Okay, so Quick Limited, KOL, is in the process of finalizing its financial statements for the year ended 31st December 2019. Following information pertains to KOL's intangible assets. A. On 1st January 2019, KOL entered into an agreement to replace existing ERP software with a new ERP software at a cost of 360 million. According to the agreement, 40% payment was made on signing of the contract, while the remaining amount was paid evenly over customization and installation period, which completed on 1st October 2019. The entire cost of project was financed through a running finance from Honka Bank at a markup of 15% per annum. The software became operational on 1st November 2019. KOL expects to use it for a period of 9 years. The existing ERP software will be continued till 31st December 2020 and disposed of for 40 million Ghana cedis.
Okay, that's not my focus. Let's come here. What can you identify over here concerning the intangible assets? Okay, you can see that there's also going to be a deferred payment, but the question is not telling you anything about this one. So it means that the payment terms will not be that long as compared to the first one that we solved. Okay, so you just recognize all the 360 as what? As value of the purchase price of the software. They say 40% was paid on signing of the contract, while the remaining amount was paid evenly over the customization and installation period, which completed on 31 October 2019. You can say that's like 10 months, isn't it? So
Yes,
10 months, that might not be having a greater financing component as compared to 2 years and 3 years. So we just use the cost of 360 as the purchase price of the item. Okay, so we have bought the software at 360, but we have paid 40% of this amount. The remaining will be a liability which will be paid over the installation and the customization of this one. That is not my problem. The entire cost of the project was financed through a running finance from forget about the name of the bank, at a markup cost of 15% per annum. Do you know what they are calling the markup? The markup of 15%. Just if they say markup, if they say the bank is charging markup, what does it mean?
Their interest on the amount.
Yeah, that is the interest, because if you are a seller, you are charging markup. You are charging markup on what you are selling. The bank is also giving you money, so they are also charging their profit. Their profit is just the interest on the amount. Okay, so the markup that they are talking about is the amount. They have started installing and customizing this thing from the date of purchase to 31 October 2019. You can see that the software became operational on 1st November 2019. Okay, Charles, apart from intangible asset, what other standard can you identify here?
Borrowing cost.
Yeah, borrowing cost. So the money of 360 was taken from a bank to finance this one, and the asset has taken 9 months. No, the asset has taken 10 months to be ready for use. That 10 months can be deemed to be substantial. So you charge interest for 10 months and add it to the initial cost of the asset. And you start amortizing from 1st November to the end of the year, which will be 31 December. So you do 2 months, you charge depreciation for 2 months, and 2 months of the interest will go to profit or loss. Okay, that is what I want to open your mind to. That the software has taken 10 months to be ready for use, and they have taken money from a bank to finance the purchase. So the interest for the 10 months that should have been taken to profit or loss should be added to the initial cost of the asset, because during that period, the asset is still not ready for use. That is what I want you to open your mind to. Apart from that one, I'm leaving that one for you. Okay, let's come to question about the revenue from contract with customers.
So IFRS 15, revenue from contract with customers. Question 1. On 1st October 2018, Cushion Construction Limited, KCL, entered into a contract to construct a commercial building for a customer for 50 million Ghana cedis and a bonus of 10 million Ghana cedis if building is completed on or before 31st December 2019. Till 30th June 2019, KCL expected that the building will be completed within time at a cost of 40 million Ghana cedis. However, due to bad weather and time involved in regulatory approvals, the building was completed on 28 February 2020 at a total cost of 42 million Ghana cedis, of which 26 million was incurred till 30th June 2019. Part. Compute profits to be recognized for the years ended 30th June 2019 and 2020 if A. Performance obligation under the contract is satisfied over time, and B. Performance obligation under the contract is satisfied at a point in time.
All right. So if the performance obligation is satisfied over time, what do we do? Charles, how do you recognize revenue? This is a construction contract.
So we measure progress at every point in time.
Okay. And so this one, what are you going to be doing? Based on the information given to you right now, what are you going to be, what of the method are you going to be using to measure the progress?
Since they are giving us a hint on the cost incurred, we use the input method.
Okay. So let's come to the A. So the A, let's come to the A there and see what we can do. So let's come to A. Okay. So that will be IFRS what? 15. IFRS 15. So we have the question 1A. Okay. So question 1A is saying that revenue over time, isn't it?
Yes, sir.
So we do over time. So the over time now, what do? We have to, so they're asking it for 2 years, isn't it? Let's check there. Okay. So let's come here. The total cost incurred was what?
42 million.
Okay. Total cost was 42 million, but that cost was given to you in the following year, isn't it?
Yes, sir.
But in 2019, what was the total cost that you are expecting to incur?
26 million.
20,
26.
no,
Okay, 40. 40.
40, isn't it?
Yes, sir.
Okay. So let me take that again. However, due to bad weather and time involved in regulatory approval, the building was completed on what? On 28 February at a total cost of 42 million, of which 26 million was incurred to 30, was incurred to what? 30th June 2019. Okay. Now, let's come to the first part. Till 30th June 2019, KC expected that the building will be completed within time at a total cost of 40 million. So up to the end of what? 30th June 2019, the expected cost or the total cost to complete the contract was what? 40 million. Okay. As at this particular date, we don't have idea about the cost increasing up to the 42 million. No. So till 30th June, we are still expecting that the building will be completed within time at a total cost of 40 million. What it means that the 26 million that we have incurred at that date, we are expecting additional 14 million to be incurred to complete the contract. So for 2019, this is how you are going to measure the revenue. So you come here and measure the percentage of completion. So let me have this particular one. So let me have 30th June 2019. Okay. So for each year, you determine the total cost of the contract. For 2019, we are expecting total cost of the contract to be 40 million. We incur 26 and we are expecting what? Additional what? Additional 14 to be incurred.
14.
Okay. So we come here, our percentage of completion will now be percentage of completion will now be 26 divided by
40.
Okay, what are we having?
65%.
So 26 divided by 40 multiplied by 100. So the percentage of completion is what?
65%.
Okay, so 65%. So what do? In 2019, we recognize revenue up to 65% and also cost of sales up to 65%, isn't it?
Yes, sir.
So our revenue will be 0.65 multiplied by, what is the total contract price? Is that 50 million?
Yes, sir.
So what are we having?
32.5.
30.
32.5.
32.5. Our cost of sales, if you're using the input method, will still be the same as the cost incurred to date, isn't it? So that will be
Yes, sir.
0.65 multiplied by the total cost as at this date. The total cost at the end of 2019, we are expecting to complete the building at 40 million. So we have incurred 26 million and we are expecting to incur what? Additional 14 million. By the end of the period that will be in 2020, we have incurred 42 million in all. The additional cost, we are not having provision or we don't have idea about the additional cost. The cost has increased by additional 16 million. Okay. But as at the end of the first year, we are expecting to complete the total contract at 40. So we measure to the 40. Okay, so we now have 26 million over here. What will be the profits? The question is asking us to recognize rolling revenue. So compute the profit.
Hello, sir.
Yes, yeah.
Please, how about the bonus?
The bonus we are not estimating. Let me see. Okay, so let's come.
Well, it's as if we've been able to beat time.
Okay, no, they are saying that till 30th June 2019, the KCL expect that the building will be completed within time at a total cost of this one. However, due to bad weather and time involved in regulatory approval, the building was completed on 20th February 2020 at a total cost of 42 million, of which 26 million was incurred to what 30th June 2019. So when are we saying that entered in the contract to construct a commercial building for customer for 50 million and the bonus of 10 million if the building is completed or on or before 31 December 2019. Okay, what you do is if you come to the bonus here, okay, the bonus here at the inception of the contract, are we expecting that the building will be completed before that time?
Yes, sir, we were.
Okay.
At the inception.
At the inception.
Yes.
Okay. You are very sure that it will be completed, isn't it?
Yes, sir.
Yes, sir.
Okay. The only time that we include the bonus is if you are certain that at the time that everything will be resolved around uncertainty relating to the building, there will not be a reversal of that particular bonus, of that particular variable consideration from the transaction price. At the end of the day, should the bonus be part of it? Should the bonus be part of the what? Should the bonus, after we have resolved the uncertainty surrounding everything that is happening, should the bonus be part of the contract price?
No, sir.
So it means that even if you recognize the bonus, you are still going to be reversing the bonus back, isn't it?
Yes, sir.
So just ignore.
Okay.
Okay. So you only recognize the bonus if it is certain. If it is certain that the bonus will be received. And at the end of the day, if after the contract, there will not be any issues after performing the contract, there will not be any issues that will make us to remove the bonus. So they are certain at the beginning of the year, but the bonus will be given to you at the end of the project. At the end of the project, are you sure you are going to be receiving this amount? You are very sure, but at the end of the project, are you going to be receiving? No, because you are not able to complete the work. So if you include the bonus, you have to reverse the bonus back again, and that's going to be having the same effect. So just ignore the bonus and what? Because the bonus will not be received. The bonus will not be received. But if we are not giving any information about the work being completed, okay, if we are not giving any information about the work being completed, then on 30th June 2019, we are going to be recognizing the bonus because we are very certain that the work will be completed. By the end of the issue, there will be a reversal of the consideration from a transaction price. So if you know that if uncertainty surrounding the bonus or the variable consideration after it has been settled, if you know that it will cause a significant reversal in the transaction price, please don't recognize that. So if you recognize the bonus, you still have to reverse the bonus back because you are not going to be getting the bonus. So just take it out. So I hope you're okay now.
Yeah, I'm good.
Okay. So the profit, what are we getting as a profit there? What are we getting as a profit?
You're having a profit of 6.5.
6.5. Okay, the profit is the difference between the revenue and that particular one. So the profit is also calculated like this. You can calculate the total profit on the contract. Okay, what will be the overall profit? As at this particular date, what will be the overall profit?
It's 10.
10
10
million.
million.
Okay, so we have the contract price. That will give us the 50. We have the total cost of completing the contract. So as at these dates, we are expecting what? 40 million. Okay. So we'll be having 10 million, isn't it? So the 10 million is the full work done, isn't it? So when we
Yes.
have done
Yes, sir.
65% of that, so we have percentage of completion, we multiply by 0.5, and that will give us a profit of 6.5.
6.5. Yeah.
Or you can just subtract the cost of sales from the revenue. But let's come to this particular year now. Okay, you don't have to do anything, please. The work has been done. The work is completed, so you don't have to measure percentage of completion again. Okay, what is the total revenue now? So let's come to 2022 now. What's supposed to be the total revenue? It is 50 million, isn't it?
Yes, sir.
But you have recognized 32.5 out of that already. So what will
Yes,
be
sir.
the revenue that will be recognized? The work has been done, so 50 minus 30.
17.5.
Okay, that will give us 17.5. Okay, then what will happen? The cost of sales is now 42 million, isn't it?
Yes, sir.
But you have recognized 26 already. The
Yes, sir.
cost that you have incurred is the cost to date. The cost from the date of the what? The contract up to now. That is the total cost of 42 million. But you have recognized a cost of what? 26 already. So we have 42 minus what?
26.
Okay, what will be the answer?
16.
16. And that will now give us 1.5, isn't it?
Yes, sir.
Please don't go there and be saying that the revenue is 10. So if you have done the work, the profit is 10. If you have finished the work, then they have to recognize what? A revenue of 3.5. No, the contract, the cost is no longer 40. The cost has now increased to 42 million. The cost has now increased to 42 million. Okay. So let's come here. Okay. If you are including the variable consideration for the first year, you see that you are going to be recognizing 0.65 of that, isn't it? Which is a 10. That will also be 6.5. By the end of the year, what will happen? You have to reverse this one, isn't it? You have to reverse what? The bonus, because you have recognized the bonus of 6.5, which you don't have to recognize. So you only include the what? The variable consideration if you are very certain that after the uncertainty has been resolved surrounding whatever condition that they are giving the bonus on, there will not be any significant reversal in the what? In the previous transaction price, which is the contract price plus the bonus. So since at the end of the day, they have not completed the work within that particular one, you just ignore the bonus there. Okay, so this is over time. Let's look at a point in time. At a point in time, what will happen? If the revenue is recognized at a point in time, in the first year, will there be any revenue in that year? At a point in time. Just at a point in time is what?
So with that one, there is no progress situation over there. We recognize revenue when performance obligation has been satisfied, and that's at the end of the year. That is when the work is actually completed in 2020. Is it 2020? Yeah.
So if you are doing revenue at a point in time means that the customer will obtain. Okay, you only recognize revenue when the customer obtains possession of the item or when control has been passed to the customer. So at a point in time, you only recognize revenue when you have delivered the items to the customer, when the customer has accepted what? Delivery. So it means that in 2019, what will happen?
There will be no revenue recorded.
Okay, but if you count to 2020, what will be the profit there?
The profit is going to be 50 million minus 42 million.
And that will give us what?
8 million.
That's all. So if it's a point in time, you only recognize revenue when the customer obtains control over the what? Over the item. So any amount that the customer will be paying upfront will be treated as a loan, but we don't have any situation like that over here. So 2019, the goods has not been given to the customer. So there is no way you are going to be recognizing what revenue. So no revenue in 2019. However, the work has been completed in 2020 and the customer has now obtained possession of the building. Therefore, we are going to be recognizing revenue in that year to the 50 million, cost or cost of sales of 42 million, and that will give us a profit of 8 million. Okay. But you can see that at a point over time, we recognize the 8 million over 2 years, isn't it?
Yes, sir.
But at a point in time, it will be recognized when the goods have been delivered to the person. Okay. Let's come to the 2. Let me use the 2 also.
Okay. So question number 2.
Yeah.
Bridge North has undertaken a $5 million contract to repair a railway tunnel. The contract was signed on 1st April 20X8, and the work is expected to take 2 years. This is a contract where performance obligations are satisfied over time, and progress in satisfying performance obligation is to be measured according to percentage of cost incurred to date. Bridge North has an enforceable right to payments for performance completed to date. As at 31st December 20X9, the details of the contract were as follows. So we have 20X9 and 20X8 with information relating to them. Total contract value, cost to date, estimated cost to completion, and cash received to date. Required. Compute the revenue, cost of sales, and hence profits Bridge North has to recognize in the statement of comprehensive income for the years ended 31st December 20X8 and 20X9. How much contract asset into bracket liability is to be recognized in the statements of financial position as at 31st December 20X8 and 31st December 20X9.
Please, you have to pay it. You see, these things, they are not giving you these things for anything. Okay. They are not giving you these pronunciations for anything. Okay. You see, the question can tell you that this contract is where performance obligations are satisfied over time, and progress in satisfying performance obligations to be measured according to percentage of cost incurred to date. They can tell you that. And they can also, the question can further tell you that the entity has what? The entity has enforceable right to what? To payment only after the customer has accepted delivery of the item. In that case, this particular contract cannot be recognized at a point over time. Because if you are receiving payments after delivery, it means that you are receiving payments after the customer has accepted what? Delivery of the items. So it means that you have to recognize the revenue when the customer receives the items. So they can give you all these things and make this one and to change everything. Okay. So these things that they are telling you over here, it means that if you are saying that you are going to be, you have the enforceable right to payment for performance completed to date, what it means is that even if you don't transfer the asset to the customer will still pay you for the work done. So it means that you are not recognizing revenue at a point in time. The question can tell you that the customer will accept or the customer will only pay after delivery of each of the items. It means that the customer will only pay when the customer obtains possession of the items or when the customer accepts the items. That will be performance obligation at a point in time. But this one, you have the enforceable right to payment for performance completed to date. I've done some part of the building, so you have to pay me for the work done. I haven't given the building to you, but you are paying. So it means I have to, whenever the work is completed, you are paying me. So I'm measuring performance over time. That is why they are giving you these ones. So they can say everything and they will say small thing and that will change everything. Okay, let's come here. We are doing this for 2x what? 2x8, 2x9, isn't it? Okay.
Yes, sir.
The question is telling us that they are using input method. Is that correct?
Yes, sir.
Okay. They are using input method. So let's come to 2x8, the revenue that should be recognized. And so let me have 2x8 over here. 2x8, the revenue that should be recognized. And also, so let's determine the percentage of completion first. Okay. What will be the percentage of completion? Percentage of completion will be the cost incurred to date. What is the cost incurred to date?
1,800.
Okay, that will be 1.8 million, isn't it?
Yes, sir.
So in 2008, 2x8, what is the total cost to complete the contract? What is the total cost of the contract? We have incurred 1,000 and we are expecting additional what?
Need an additional 2,000. So that's
Okay. So we are expecting to incur total cost of what? So in 2008, in 2x8, we are expecting to incur a total cost of what? 4 million over the what? Over the 2 years. So if we are expecting to incur a cost of 4,000 and we have incurred a cost of 1,800, what portion of the work has been done?
45%.
So 45%, isn't it?
Yes, sir.
So revenue that will be recognized will be 45% of the contract value. What is the contract value?
5 million.
5
Okay.
million.
So that will give us 5 million. What are we having?
2.25.
2.25 million. What will be the cost of sales? Cost of sales will still give us the 1.8 million.
1,000. Yeah. Yes, please.
Okay. So if you are using the input method, the cost of sales will still be that one. Total cost is 4,000. You have incurred this cost, so that will still give us 1.8 million. What will be our profit?
0.45.
Okay, our profit will be 2.25. You can actually calculate the total profit and find 45% of it. So we have 1.8 million. What are we having?
0.45.
Okay, 0.45. Please, we are not doing magic. This is something that some of us that are in the construction industry you have been using. Okay, you are doing the work. If you have done what? If you have done 4,000, if you have done the full work, the total cost that you have to incur is 4,000. So if you have done the full work of 4,000, it means that you are going to be receiving a total cost of 5,000. So the total cost is 4,000. So if you do all the work, you are going to be receiving a value of 5,000. Now you have incurred only 1,800. So what will be the corresponding revenue? Change of subject. That's what we are doing over here. But the easiest way to go about it is to find the percentage of completion. So 4,000 is the full work done. That is 100%. You have done or you have incurred a cost of 1,800. So out of 100%, what is the portion of the work that has been done? 4,000 is a full work done. That is 100% complete. So if 4,000 is 100% complete, 1,800 will be what? 45%. So it means that you have completed 45% of the work. You have to recognize revenue up to the percentage of the work done. Let's come to the contract assets. Okay, let's come to the contract assets. The contract asset over here is going to be very simple. Okay, the contract assets. So if you want to bill the customer, how much are you going to be billing the customer?
The cost plus the profit element.
Okay, so if you want to sell the contract to the person now, it will be the cost. If you sell a selling price, so that will be cost, the cost of the contract or the cost incurred to date, the cost to date, that is 1.8 plus the profit of what?
0.45.
So in every case, the billing will always be what? The billing will always be the selling price. But I'm saying that sometimes the cost incurred will actually be higher than what? Higher than the cost of sales. It means that the entity has some closing inventory over there. So you either treat it as an inventory or you put all of them together and name it contract asset. Just I hope you can remember that, isn't it?
Yes, sir.
Okay. So how much has been received from the customer? We're supposed to receive 2.25 from the customer. But how much has been received?
1.5.
So we have received only 1.5 from the customer. So it means that the customer is still owing us how much? So the cash received is 1.5 million. So how much will be left?
0.75.
So 0.75. So the customer is still owing us what? 0.75, which we call the contract asset, or you can call it receivables. You are selling to the person at 2.25. The person has paid only what? Only 1.5. The person is still owing you 0.75, which we call the contract asset. Or you can also call it receivables. There's no issue with that. Let's count to 2x9. Okay. 2x9, what will be the percentage of completion?
So that's 3,600 over 4,500.
3,600 over
4,500.
Okay. Please, the percentage of completion is calculated on cumulative basis. What is the portion of the work that you have done so far? We don't do it in every year or every month. No, we do it. What is the percentage of the work that you have done so far from the beginning up to the end? That's how we do. So this will be the cost incurred to date, 3,600, divided by the total cost that you are expecting to incur to complete the contract in year 2. We have incurred 3,600 already. We are expecting to incur additional 300, additional 900.
3%.
Okay, so that will give us 4,500 multiplied by 100%. What are we having?
80.
Okay, that will give us 80%. So what will be the revenue that we have to recognize for this year? Okay, that will be 0.8 multiplied by 5,000 minus what?
2.25.
Okay, the 80% is the revenue that you have to recognize from the time that you started with the contract up to now. So the 80% is the overall completion of the contract. So the revenue that you have to recognize up to date, that figure will give us what? 0. This one, I'm sorry, to give us 4,000, isn't it?
Yes, sir.
Okay, but we need to recognize a revenue of 4,000 from the time of the starting or from the start of the contract up to now. But that 4,000 we have already recognized 2.25 in the previous year. So you recognize the remaining one. The 2.25 should be the 4,000 should be recognized over 2 years. So you have recognized 2.25 in the first year already. That's what should be the remaining over here.
1.75.
1 point what?
75.
So we have 1.75. So 1.75 million. The cost of sales up to date should be 3,600, isn't it?
Yes, sir.
Yes,
Okay.
sir.
But we have recognized what? So that will still be, the cost of sales will still be 3,600. But we have
Yes, sir.
recognized 1.8 out of it. Okay. The cost incurred to date, the cost of sales should be 3.6 up to date, but we have recognized 1.8 in the previous year. So it means that we have to
Yes, sir.
recognize what? 1.8
0.8.
in this particular year now. Is that okay?
Yes, sir.
Okay, what are we having there?
We're having a loss of 0.05.
What did we say about the loss? We said something about the loss the last time. Just can you remember?
Yes, you said, okay. What I remember about the loss is that if there's a loss on a contract, we treat the full loss in that year.
And we do what?
We treat it as a period cost, like the full cost in that year.
Okay. 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 So you can see that there's no loss on the contract. If you look at the contract on the full basis, there's no loss on the contract, isn't it?
Yes, sir.
If you look at a contract on the full basis, there's no loss. Okay. If you look at a contract on full basis, there's no loss on that. I hope that is fine.
Yes, sir.
Okay. We only treat the loss as what? As onerous contract. I hope you can remember onerous contract.
Yes, sir.
Yes, that is
Okay. We treat the loss as onerous contract when what? Okay, so let me have 5 here. 0 points, this one. Okay. We treat the what? The loss as onerous contract when the loss is arising from the contract as a whole. What it means is that let's come here. Let's assume that our contract price is what? Is 5,000. By the end of year 2, we are now expecting to incur a cost of 5,200 in all. So you can see that we are going to be making a loss of 200 on the contract as a whole, isn't it?
Yes, sir.
Then we make provision for the 200 because for us to complete the contract, we have to incur this one. So we treat this as an onerous contract. But if you look at the contract as a whole, there is no loss on the contract. So we can't treat the loss as what? As onerous contract. Okay, as a provision. So you come here and have the profit for the year or loss for the year. The profit or loss for this year will be 1.8 minus 1.75. That will give us 0. What?
0.5.
Okay, 0.05 as a loss, isn't it?
Yes, sir.
Okay. If we want to bill the customer now, how much are we going to be expecting the customer to pay? How much are we going to be expecting the customer to pay? Okay, forget about that one. Okay, we calculate the contract asset on what? On total basis. Okay, so let's come here. We have the contract asset over here. So we calculate our contract assets up to date. Okay, so let's come here to, let's see if they are asking us to do it year by year and see what we can do. So how much contract assets is to be recognized in the statement of financial position as at 31 December 2x8 and 31 December 2x9. Please, you have to pay attention. They are saying that as at, isn't it?
Yes, sir.
Okay. As at is on cumulative basis. So let's come here. Our contract assets will be the cost up to date, the cost to date now. So we have the cost to date. You can see that the same question that we saw, but it was been modified. We saw some question like this. Okay. So the cost incurred to date, how much is that? 3,600, which is 3.6, isn't it?
Yes, sir.
What will be the cumulative profit on the contract so far? Cumulative profit.
0.95.
Are you sure? Cumulative profit on the contract so far is what?
0.4.
0.4.
0.4.
Yeah, that will be, you see, the first one that the first profit was recognized, that will be 0.45. Then loss will not cancel that one to be 0.4.
0.4. Yeah.
Or you can also do it 0.8 multiplied by the new profit, now that will be 500. You can see that at the end of the profit from the total contract will now be 500, because we are going to be incurring a cost of 4,500 against 5,000. So 0.8 multiplied by 500, that will now give you 400. So the profit will now give us 0.4 now. Okay, what will be the full amount over here? This will be 4 million. Okay, what is the amount that has been received up to date?
2.4.
Cash received to date, that will be 2.4. Our contract asset will be what?
1.6.
Okay. So for the contract asset is done on cumulative what? Basis. Contract asset is done on cumulative basis. So they are asking you, as at the end of every year, what should be the contract asset? The first one was 0.75. This one will be what? 1.6. At any point in time, what you have to know is that the revenue or the cost of sales, everything that you are calculating, they are all based on cumulative what? Figures. They are all based on cumulative figures. So the revenue is the revenue that you have to recognize on the contract up to today. The revenue that you have to recognize on the contract up to today. The profit that you have to recognize on the contract up to today. So percentage of completion is done from the time that you started the work up to now. Okay, so that's how we go about it. Any issue, then I will move on to the next one, which is the next one is what?
Leases.
Okay, so take the leases, let's see.
Okay, so IFRS 16 leases. Question 1. On 1st July 2010, Jumaso PLC began to lease a plant under a 5-year lease. The economic life of the property has been estimated at 8 years. The lease rentals payable by Jumaso were 5 million.
Take the second one.
Okay. Question number 2. On 1st January 2020, Optimism Limited (OL) entered into an agreement to lease a machine from Fascinated Bank Limited (FBL). Details are as follows. 1. The lease period is agreed at 6 years. However, the lease contains an option for OL to terminate the lease at the end of 4 years upon payment of 1 million. OL is reasonably certain to exercise this option due to anticipated technological changes. 2. First annual installment amounting to 12 million was paid on 1st January 2020, and all subsequent annual installments are payable on 1st January, subject to decrease of 2 million in each year. 3. Market rate for similar transactions is 6% per annum, but as an incentive to OL for entering into the lease, FBL has incorporated an implicit rate of 11% per annum, which is known to OL. 4. The fair value and useful life of the machine are 40 million and 7 years respectively. 5. OL incurred initial direct cost of 3 million. Required. Prepare relevant extracts from OL statement of financial position, statement of profit or loss, and notes to the financial statement for the year ended 31st December 2020.
Now this thing cannot show again. A minute, let me see. Let me stop sharing and see. All right, check this one. Can you see my screen? Can you see something?
I can see it now. Yes.
What is there? For me, myself, I cannot see. Nothing is showing.
It's very blank. Yeah.
Okay.
It's blank. It's blank.
So maybe it is the other way that let me work on it and come.
Hold on one minute.
All right. So let's move on. So let's come here. Okay. This is the question that we have to solve for the lease. Okay. So they are asking us to. So let's come here. We need to determine what? We need to determine our lease period and the other issues over here. So let's come here. So we are looking at the lessee. The lessee is the O. So the OL. So we have the IFRS what? 16. So the IFRS 16 is what we do. So at the initial date, what do we have to do? We recognize lease liability and right of use, isn't it? At the initial date of the what? Of the lease, the lessee has to recognize what? Right of use and lease liability, isn't it?
Yeah.
Okay.
Yes, sir.
So what is the rental payment? Every year rental payment. So what is the rental payment? The rental payment is what?
Okay.
Annual rental is what? It's 12 million. First annual rental payment, 12 million was paid on this one, and all subsequent annual installments are payable on 1st January, subject to decrease of 2 million each year. Okay. Market rate for similar one is this. We use the rate implicit in the list. But let me start from the beginning so that we can just simplify this and move on to the next one. Okay, the lease period is agreed as what? 6 years. However, the lease contains an option for OL to terminate the lease at the end of the 4 years upon payment of 1 million. Okay, upon payment of what? 1 million. OL is reasonable certain that is reasonably certain to exercise this option due to anticipated technological what? Changes. Okay. So the lease period will now be what? It was 6 years, but they have the option to terminate.
years.
They are now certain that it will be terminated. So the lease period will now be 4 years, isn't it?
Yes, sir.
Yes, sir.
Okay. So let's look at the rental payments now. They are paying in advance, isn't it?
Mhm.
Okay.
Yes, sir.
So the first year will be 12 million, isn't it?
Yes, sir.
Second year will be what?
10 million.
That will be 10 million. Okay. The third year will be what?
8.
8 million. And the last year will be what?
6.
6 million plus the what?
Plus the termination.
Termination. Okay. So we can now discount, isn't it?
Yes,
Okay.
sir.
Yes, sir.
So let's now discount over here. Let's now discount. We have the years. We have the cash flow. We have the discount factor and present value. So we have year one. You can see that we are paying now, isn't it?
Mhm.
So if you like, you can put year 0 here because we are going to be paying the 12 million now, isn't it?
Yes, sir.
Okay. So we have 12 million. Discount factor is what? The implicit
One.
is 11%, isn't it?
Yes, sir.
Okay, we use a rate implicit in the lease. If that one is not ready, we use the borrowing rate of the lessee. So that will be 11%. So this will be the same as 1.00, isn't it? Okay, if you like, you can ignore the 12. We are looking for the liability. So you have already paid 12 million. So what are the remaining amount that you have to pay? So we only present value the remaining amount. We only present value the remaining amount because we have already paid the 12. So we are looking for the lease liability. So let me just take this one. We are looking for the lease liability. So looking for the lease liability, what we do is that we find the value of the remaining amount that we are going to be paying. So let me just take that one. So we have one. The cash flow will be 10, isn't it? The 2, we are going to be having 8. The 3, we are going to be having 7. I hope that is okay.
Yes, sir.
Okay. So what is the discount factors?
So for year one, we have 0.9009.
0.9009.
9009.
3 decimal place. Is that?
Yes, sir.
Okay. Then the second year is what?
0.812.
0.812. Okay.
0.731.
0.731. How much are we having?
Year three, 5.12.
5.12.
Year two, 6.496.
So 2 decimal place is what?
So 6.49.
6.50 or 49 just.
Sorry, 50. Year one, I'm having
9.01.
9.01.
The total will give us what?
Total is 20.63.
20.63.
Okay. So 20.63. This is our lease liability at the date of the inception. Okay. Let's now count to our right of use at the date of this one. The right of use will be the lease liability. So it's just like we are buying the asset and we are paying on what? On deferred term basis. So the present value of the amount that we are going to be paying in the 3 years time. It's just like how we have done it for the intangible assets. You can see that we are sending some amount into the future. So it's just also like we are paying with what? with financing costs. So we find the present value of all the amount that we are paying. But we have actually done a deposit. So we have the advance payment already. So we take the cash price. So the advance payment is the cash, it's just like the cash price of how much have we paid? That is 20 million. There's a 12 million rather. Okay, we have paid 12 million already. So if we should have money and pay, we have already paid the 12 million and we are still owing the people what? 20.63 million. So it means that what they are selling to us is what? 20.63 million plus the amount that we have already paid. So the right of use is the lease liability plus any deposit or any initial deposit. Okay. Did the lessee incur any direct cost? Are they incurring any direct cost over there?
Yes, 3 million.
Okay. The right of use is just treated like any other asset. It's asset that we are taking from the person. Okay. So the direct cost over here can be a delivery cost, can be installation cost. It's just that the direct cost is just like any other direct cost under IAS 16. But they just put it together to name it direct cost. So it can be installation cost, it can be delivery cost, it can be other costs that are necessary to bring the asset to the state that it will be ready for use. So what we do is we add that particular cost to the initial value of the item. So our direct cost will now be 3 million, isn't it? Okay. So what is the total value of the right of use?
35.63.
35.63. Okay. Subsequent measurement, what do we do? So subsequent measurement, the asset will be used. So if the asset is being used, it means that we are going to be consume the asset over each useful life. So we have depreciation of the right of use. You should be mindful that the lessee has the right to carry the asset under either cost model or revaluation model. The right of use is just like any other asset. They can even carry out impairment tests on the right of use. If you see something like that, don't be confused and say you haven't seen it before. The right of use is just like any other asset. It's the asset that they are using. The asset can involve in accidents, and their benefit will be reducing. So they have to carry out an impairment test. The product that you're using the asset to produce, the product cannot be on demand again, and the asset will be there idle. The benefit will be reducing, so they can carry out an impairment test on the right of use. They can be revalue the right of use. The lessee can choose to account for it under either cost model or revaluation model, but the default method is always the cost model. So we have 35.63 over 4 years. Is that correct? I'm having 8.91.
Yes, sir.
Okay. So what do we do to the lease liability? We have to amortize the lease liability now. So this is just like a deferred payment. Are you okay? So we are owing the person. So every day we have to be paying interest. It's just like that one we have to be amortizing with the finance cost, like the deferred payments. So we have the balance brought down, which is the opening balance of the lease, which will be 20.63. Then we have a finance cost of what? A finance cost of 0.11 multiplied by 20.63. How much are we going to be? How much are we having? Having 2.27.
2.27.
Okay. Are we going to be paying any amount at the end of the year?
No, sir.
Okay. The amount will be paid the following year. Okay. At the start of the year. So we have the rental for this year has already been paid at the beginning of the year. So our liability will now be 20 point what? Okay. So that will be 22.9 million. So you come to your statement of profit or loss. You have depreciation of the assets to be 8.91. Then you have finance cost. Finance cost to be what? 2.27. Statement of financial position. What are we going to be having? Statement of financial position. We have right of use under assets. That will be 35.63 minus what? 8.91. 35.63 minus 8.91. Then we come to current liability and non-current liability. We can split the what? The lease liability under current and what? And non-current. Okay. This one is very simple. Advance payment. We are paying 10 million at the beginning of the following year. Okay. Then we come to the non-current component. Non-current component. The question is, what is the total amount that we have to pay at the end of this year? The total amount that we are owing the people at the end of the year. We are owing 22.9, but we are paying 10 at the start of that year. It means that will be 12.9. Please, it is the total amount owing at the end of the period that we are splitting. So it is a 22.9 that we are splitting. So you're supposed to pay the people 22.9, but you are paying 10 million at the beginning of the what? Of the next accounting period. That is going to be paid within a day. That is a current liability. It will be paid within a year. So we take it as what? Current liability. And the remaining one, if you are paying 10 million out of this at the beginning of the year, it means that remaining will be paid within the what? Within the remaining lease period. That will be 12.9. That is how we go about this one. A very simple exercise there. Okay. Let's come to just pick the earnings per share for us.
Okay. IS 33 earnings per share. Question number 1. The issued share capital of GH Trust, a publicly listed company on the Ghana Stock Exchange at 31st March 2007, was 10 million Ghana cedis. Its shares are denominated at 25 pesos each. GH Trust earnings attributable to its ordinary shares for the year ended 31st March 2007 was 10 million Ghana cedis. Year ended 31st March 2008. On 1st July 2007, GH Trust issued 8 million ordinary shares at full market price. On 1st January 2008, a bonus issue of 1 new ordinary share for every 4 ordinary shares was made. Earnings attributable to ordinary shareholders for the year ended 31st March were 13.8 million Ghana cedis. Year to 31st March 2009. On 1st October 2008, GH Trust made a rights issue of shares of 2 new ordinary shares at a price of 1 cedi each for every 5 ordinary shares held. The offer was fully subscribed. The market price of the company's ordinary shares immediately prior to the offer was 2.4 Ghana cedis each. Earnings attributable to shareholders for the year ended 31st March 2009 were 19.5 million. Required. Calculate GH Trust earnings per share for the 2 years ended 31st March 2008 and 2009, including comparative figures.
Okay. So earnings per share, very simple one. Let's see. Okay, they are asking us to calculate for 31st March 2x8, isn't it? Okay,
Yes, sir.
31st March 2x8, the year will start from 1st April 2x7, isn't it?
Yes, sir.
Okay, so let's come to the year under consideration there. Okay, so the issue share capital of GH Trust, a publicly listed company on the Ghana Stock Exchange market at 31st March 2x7 was 10 million. Each shares are denominated at 25 pesos each. GH Trust earnings attributable to each ordinary shareholders for the year ended 31st March 2x7 was 10 million. The question is asking you for comparative figures too. So it means that you do it for 27, 28, and 2x9, and you show the impact of the bonus issue on each of them. Okay, so what we do is that let's calculate the earnings per share for, so that will be IS 33 earnings per share, and we have question number 1. Very interesting one. So question number 1. So let's calculate the earnings per share, basic earnings per share for 2x7. 2x7, there is no full market value for the year of 2x7. There is no issue of full market value. There is no issue of right issue or anything. It was just the shares at the beginning and the same as the shares at the end. What was the profit made for that particular year? 10 million, isn't it?
Yes, sir.
So we have 10 million. So that 10 million divided by what will be the number of shares? Let's pay attention to the calculation of that. Okay. They are saying that their share value is what? 10 million Ghana cedis, isn't it?
Yes, sir.
And each share is going for what?
25 pesos.
So what will be the number of shares? How many shares will be issued at 25 pesos? That will give us 10 million.
4 million.
Is it 4 or 40?
40 million.
Okay. Okay. So we have the number of shares. So we calculate their number of shares. Their number of shares to be 10 million divided by 0.25, isn't it?
Yes, sir.
That will give us 40 million shares. 40 million. So that will give us 40 million. So we have 40 million here. What are we having as the earnings per share?
0.25.
0.25. Let's we do the earnings per share in the highest denominator of the currency. So multiply by 100, change it to pesos. If it is 0 point something, please change it to, that will give us 25 pesos, isn't it?
25 pesos. Yes, sir.
Okay, so that will give us 25 GP. Okay, let's come to the year. The year end 31 March 2x8. So let's come to the issues that have happened there. We know that the basic earnings per share for 2x8 will be calculated as what? The earnings for that particular period. What is the earnings for that particular period?
13.8.
Okay, 13.8 million. But we have to calculate the weighted average number of shares, isn't it?
Yes, sir.
So we have the weighted average number of shares. So let's go and calculate our weighted average number of shares for this one and bring it. Okay. So we have our weighted average number of shares. Okay. At the beginning of the year, we have 40 million shares in issue, isn't it? So we are going to be looking at the date. At the beginning of this year, the shares that were there in 2x8 will be the same shares that will be in issue from the beginning of what? The 2x8 year. So 1st April, 2x7, they will still have the 40 million shares there. That is their shares in issue. Okay. On 1st July, 2x7, the entity made what? The entity issued 8 million shares, 8 million ordinary shares at a full market price, isn't it?
Yes, sir.
1st July, 2x8, a bonus issue of 1 new ordinary shares for every 4 ordinary shares held was made. Okay, so earnings attributable to ordinary shareholders for the year ended 31 March 2x8 were this one. So I will be doing the one that you know, and I will be adding a different one so that you pick the one that is comfortable for you. Okay, so let's come here. 40 million shares will be in issue for up to how many months before the new issue? It will be in issue from the beginning of the year to what? To 30th June. Okay. It's 1st July, so we can say that will be 30th June.
On 30th June, yeah.
Okay. So April to June is 3 months, isn't it?
Yes, sir.
Yeah.
So we do April to June. So April to June, the only shares that will be in existence, the only share that will contribute to the profit within this period will be the 40 million, isn't it?
Yes, sir.
Okay. Let's come from July to when was the bonus issue? The bonus issue was made at, when was the bonus issue made?
1st January.
So that would be
20.
July to December, isn't it?
Yes, sir.
So July to December, how many shares will contribute to the profit from July to December? Would that be 48 million?
Market issue.
Would that be 48 million? Look at it.
Yeah, 48.
We have 48 from the beginning and 8 million has been.
40 from beginning plus 8.
Okay, that will give us 48, isn't it?
Yeah.
Okay. So from January to March, isn't it?
Yeah.
So from January to March, how many shares will contribute to the profit from that area? It will be the 48 million plus the bonus issue.
Bonus issues.
So what is the bonus issue there? What will be the value for the one for?
1 use for every 4. 1 over 4.
Okay, so 1 over 4 multiplied by 48. The
48.
shares that were there before the bonus issue was 48. I hope that is correct.
12 here.
Okay,
12 plus 48.
that will give us 60, isn't it?
Yeah.
Okay. So let's now come here. These shares will do what? 3 months, 3 over 12, isn't it? Okay, this will do 6 over 12. Okay, and this will do 3 over 12. But let's come here. There was a bonus issue. Okay, bonus issue is assumed to be in existence. Bonus issue is just like you are splitting the shoe. You are splitting the shares to what? You are splitting the existing shares to what? To the holders now. Okay, so what will happen is that you apply the bonus. The bonus issue is going to affect the shares in existence before the bonus issue. So those shares that were there from April to what? To January, they are going to be affected. The bonus issue will be on them. So we apply the bonus fraction. How do we calculate the bonus fraction? The bonus fraction is just like this.
5 over 4.
1 for 4 is what? What is the percentage?
Come again?
1 for 4. What is the percentage for 1 for 4?
1 over 4 times.
That will be 25%, isn't it?
25, yeah.
Okay. We are saying that for every shares that you have, we are going to be giving 25 in addition. So if you have the shares, that is 100%. So the shares that you have already is 100%. And we are going to be adding 25% on that share. That will give us 125, isn't it?
125 over 100.
Okay. And that will
5
give
over
us
4.
5 over 4. So the bonus fraction basically is 1 plus 1, the proportion of the bonus issue. So if you do it very well on the calculator, you'll be getting 5 over 4. So you apply the bonus fraction, the bonus issue will be on this one. You see, you know why we are calculating the bonus fraction? We just want to know the bonus issue will be, we assume to be in existence from the beginning. So what will be the bonus issue on these shares? That's what we are looking for. The bonus issue on these shares will be 10 million. Okay, look at this. Do 5 over 4 multiplied by 40. You'll be having 10 million. So it means that the shares at the beginning will be 50 million. That will do 3 months. That's what we are looking for by applying the bonus fraction. So what is the bonus issue on the shares at the beginning? The bonus issue will be assumed to be on the shares from the start of the year or from the time that the shares has been issued. From the time that the shares have been issued. So what we do is that 1 for 4 will be made on these shares. 1 for 4 will be made on these shares. And that will be giving us 10 million. We cannot do 1 for 4 1 by 1. Just do 5 over 4 multiplied by what? The 40. That will give you 40 plus the 1 for 4. That is what? 50. So that is why we are applying the bonus fraction. So we apply the bonus fraction on this one. Then we come over here. This shares was also there before the bonus issue. So the bonus issue will be made on them too. What will be the bonus issue on them? That will be 1 over 4 multiplied by 48. That is 12 plus the 48 is 60. But we cannot do this one like this. What do we have to do? Just do what? 5 over 4. Because 60 divided by 48 will give us something like 5 over 4. Then we multiply by 48. You get your 60 straightforward. That is why we applied the bonus fraction here. So the bonus issue will be made on the shares that were in existence before the bonus issue. That is what we are doing. But if you count to January, that was the day that the bonus issue was made. So it will not affect any share on that date. The bonus issue will affect only the shares in issue before the bonus issue. So we have this one only in this particular figure, 60 multiplied by 3 over 12. What are we having?
15.
Okay.
1 over 4, that's 15.
So this one will give us 15. Okay.
Yeah.
So what will be the figure for the remaining ones?
We have 30 and the first one is 12.5.
12.5. Okay.
The middle one is 30.
Okay. This one
So
is
in
30. Okay.
yeah, so
In
in
total,
total we have 57.5.
57.5. So this is what you do, and this is what you know. Okay, let's try this one. Weighted average number of shares. Weighted average number of shares. The shares at the beginning of the year will do a full year, will be in existence for a full year. April to what? The end of the year, isn't it? So we can have the existing shares there. So you can see that the 40 is going to be there from the beginning to the end of the year. It is going to be having a full year. So we can do 40 over here. Then I'll come to the full market value. The full market value was what? 8 million, isn't it? The full market value was 8 million, isn't it?
Yes, sir.
Okay. Let's come here. What will be the bonus issue on each of them? The bonus issue is 1 for 4. So what will be the bonus issue on this one? 1 for 4 give us 10, isn't it?
Yeah.
So I'll just do 10 over here. I'll just do this one plus 10. And this will do 12 contribution to the profit. So 12 over 12. So the bonus issue is assume we don't do that. Okay, bonus issue, you do it from that date and you multiply. No, the bonus issue is not bringing any money. The only shares that we prorata is those ones that are bringing money. We say that, okay, since we are giving the shares to it, means that you are coming as a new shareholder. So your contribution will start from the time that you have purchased the shares. But the bonus issue will be given to the existing shareholder. They are still there. We are just splitting the shares to them. So this will be having a full year. That will give us a 15 million. So this 40 will be a full year. Bonus issue on it will be what? Will be 10 million. That will be a 50. Bonus issue on this one will give us 4. Will give us 2 rather, isn't it? 1 for 4 on this one. And this will do how many months? 9 months. July to December is 9 months. What are we having? Okay. So we
7.5.
So if you add the 2, you have 57.5, isn't it?
Yeah.
Okay. So let's have this one. What are we having as the earnings per share? I'm having 22.61. $22.61 per share. Is that confirmed?
Yeah. I'm having 24.
Oh, really?
It's
13.8.
on 13.8
Yes, please. 13.8.
divided by 57.5.
Okay, 0.24, sorry. So that'll give us 24 pesos, isn't it?
Yes, sir.
Okay, 24 pesos. Okay, let's go to the earnings per share for the year December 2x9. Okay, let's come here. At the beginning of December, how many shares will be there? At the beginning, not December, 31 March, sorry. At the beginning of the 2x year, how many shares will be there? How many shares will be there in total? Would that be 60 million? The total number of shares that will be there, that will be 40 million plus 8 million plus a bonus issue of 12. Would that give us 60 million? Someone should confirm that. We have 40 million, which is the existing shares, plus a bonus issue of 10 million, plus full market value of 8 million, plus a bonus issue on the full market value of 2 million. With the total number of shares at the beginning of this year be 60 million. Someone should confirm that. Would that be 60 million? What was the shares that we have from the beginning of last year? 40 million, isn't it?
Yeah.
We have made a full market issue. That will give us 48 million, isn't it?
Yeah.
and a bonus issue of 144 has been made, that will be giving us 12 million. If we put all of them together, that will give us what?
60.
Okay. So 60, let's take the things that happen during what? During the 2x8. Okay. During the 2x8, during the 2x9, on 1st October 2x8, GA Trust made a right issue of 2 new ordinary shares. Okay. Of 2 new ordinary shares at a price of 1 cedi for every 5 ordinary shares held. The offer was fully subscribed. The market price of the company shares immediately prior to the offer was 2.4. Each earnings attributable to this one was 19.5. So that one, we don't have problem with that particular one. So we have basic earnings per share for them. The basic earnings per share for them, that will give us what? 2x9. That will give us the earnings of what? Hey, I've forgotten the figure. 19 point what? 19.5. So we have 19.5 divided by the number of shares. So we are going to be calculating the number of shares now. So let's calculate our weighted average number of shares. Okay. So let's come here. So we do the first method and do the second one. You pick the one that you like. When was the right issue made? It was 1st October 2x8, isn't it? So it means that the 60 million will be there from April to September. Is that correct?
Yes.
Okay.
Yes, sir.
April to September. So April to September, we'll be having the what? The 60 million, which will be the shares. So the April to September, the shares that will contribute to the profit will be the first 60 million that we have. So we have 60 million here. Then from October to the end of the year, which will be to March, how many shares will be there? It will be the what? The 60 million that we have and the shares that are being issued from the right issue, isn't it?
Yes, sir.
What is the right issue proportion?
2 ordinary shares for 5.
Is it 2 or 1?
Main right issue share of 2 new ordinary
Okay.
shares
Okay.
at the price of 1 cedi.
So 2 for 1 is the same as 2 over 5 multiplied by the shares that we have, isn't it?
Yeah.
So
Yes,
2
sir.
over 5 multiplied by 60. How many shares will be given from this one?
We want the
Yeah,
24.
that will give us 24, isn't it?
24.
Okay.
24.
So we have 60 and we are giving additional 24. So what will be the number of shares? What will be the total number of shares from October?
84.
84.
Okay, that will give us 84. So what we have to do is let's come and calculate the share price after the right issue, which we call the theoretical XY price. So you calculate the theoretical XY price now to determine the what? Right issue will come at a full market value at the same time what? A bonus issue. So let's come over here. We have our existing shares. Our existing shares, we are bringing 5 for what? For 2 new. 5 at what? What is the price of the shares before the right issue? 2.4. The market price of the company ordinary shares immediately prior to the offer was what? 2.4.
2.4. Yeah.
Okay, that will be 2.4 each. So 5 multiplied by 2.4, what are we having?
12.
Okay, that will give us 12. So come to the right issue. The right issue, how many shares are we getting? 2, isn't it?
2. Yes, sir. For 1 cedi.
Okay, at 1 cedi. So we have at 1 cedi here, and that will give us 2, isn't it?
Yes, sir.
So the total will now be 7 against 14, isn't it?
Yes, sir.
So our theoretical XY price will now be what? 14 divided by 7.
2.
That will give us 2.
Against 2.
Okay, what will be the right issue fraction now? Issue
Will be
fraction.
24/2. 2.4/2.
2.4/2.
Okay, so 2.4/2. What is if you do it, what is the figure that you're getting as a percentage, as a fraction?
6/5.
Okay, 6/5. So what we do is that the right issue will be having, we are looking for only the bonus issue in the right issue. So the bonus issue will be on the shares before the right issue, the shares in existing before the right issue or before the date of the right issue. So this will be affecting this number of shares, 6/5 multiplied by this one. This will do how many years? April to September is how many months? Would that be 6 months?
6 months. Yeah.
6/12. Then these shares will also do 6/12. Is that correct?
Correct, sir.
What are we having?
42 for October to March.
Okay.
And then 36 from April to September.
36 from
April to September.
okay.
Yeah, it's 36 confirmed.
Okay. So the total will give us what?
78.
79.
Is it
78. 78.
78.
So we have our listing to be 78 now. So what will be the listing now?
$0.25 or
Zero.
25%.
0.25. So that's 25 pesos.
Okay, that will give us 25 GP. Okay, let me show you another way of doing this particular one now. Okay. So let me use the weighted average number of shares doing different. We come to the comparative figure. Okay, let's come here. We know that the existing shares at the shares at the beginning, the existing shares at the beginning was 60 million, isn't it?
Yes, sir.
The 60 million will do a full year, isn't it?
Yes.
Yes, sir.
So we now have the full market value because we know that the right issue will bring a full market value and also what? A bonus issue. So we have to separate the two. Okay. How much? What is the share price now? What's supposed to be the share price? After everything, if we want to issue, without what? Without discount, we should have been issuing at 2 cedis, isn't it?
Yes, sir.
But we have issued at 1 cedi, isn't it?
Yes, sir.
It is pick one and get one for free. So it means that the theoretical XY price, the actual price that the share should have been issued, all things being equal, should have been 2 cedis. You have issued at 1 cedi. It means that the bonus issue is also 1 cedi. So the issue is how many shares are you issuing from the bonus issue? Is 24. The right issue is 24, isn't it? 2/5 multiplied by 60. Okay. So if it is 24, then 24 should have been issued at what? 2 cedis. You are now issuing at 1 cedi, and the bonus is also 1 cedi. So let's calculate the bonus shares over here. It will just be 1 over the actual share price multiplied by 24. So it means that you are issuing 12 for what? For market value, 12 for what?
12 for bonus.
Bonus. And the bonus will be on the shares in existence before the right issue. The bonus issue will always be given to the existing shareholders. So the existing shareholders are having 60 million shares. So if you come to this place, your bonus issue will be 60 plus the bonus issue of 12. The bonus issue will be on this one, which is going to be doing 12 months. So this will do full year. But if you come here, your full market value will be 12 multiplied by 6/12. Okay. So this will be, we'll be having 6 million for this, and what for that one? 72, isn't it?
Yes, sir.
72.
So you have 78. You don't have to stress yourself. If you're able to understand it, separate it like this, the bonus issue will always be on the existing shares. You can also do this one in a different way. Okay, you can multiply this now. 60 multiplied by 6 over 5. What are you having?
16.
60 multiplied by 6 over 5.
You get 12.
No, you get 72. 60
Oh,
multiplied by
sorry.
72.
Okay. What are you multiplying here? You are using the bonus issue to multiply this and get that one, isn't it?
Yes, sir.
Okay. If you multiply this like this, it means that you are multiplying for a full year. That's 72. That's a full year, 72. But you have 60. It is now increasing to 72. What is the difference?
12.
The 12 is the bonus issue included in the right issue. So you can take the 12 from the total right issue and get 12 and now prorata that one for 6 months. Okay. But the one that you are comfortable with, you can actually deal with that particular one. Let's do the comparative figures now. Okay. Let's come here. You can see that for 2x7, there was no bonus issue, there was no right issue. So for 2x7, this is what is going to happen. The comparative figure for 2x7, the bonus issue affect this one, the right issue affect this one. So you come here, what was our bonus issue fraction? So let me calculate the comparative for a comparative. So that will be earnings per share 2x9, 2x7 rather, not 2x9. So 2x7. The bonus issue is assumed to be in existence from where the shares were there. So what will happen is that our comparative figure for 2x7, the 2x7, we have our earnings per share to be 40 pesos. I hope that is correct. 2x7, 25 pesos rather. Okay,
Yeah.
25 pesos. So we have 25 pesos multiplied by the reciprocal of the bonus fraction, 4 over 5, multiplied by the reciprocal of what? The right issue, 5 over 6. So you see that the right issue, you see these ones are just the elements of the bonus issue. The bonus issue is going to be having effect on the shares from the beginning also. So 2x7, we assume that the bonus issue has been there for 2x7. So this will be for 2x7. What about 2x8? The 2x8, the only thing that is going to be affecting the 2x8 over here is the bonus issue made in what? 2x9. So we have 24 pesos here. 24 pesos multiplied by the reciprocal of the right issue fraction.
19.2.
Okay. In 2x9, there was no issue there, and those issues has actually been reflected in the what? In the calculation of our earnings per share. Charles, can you help us with the impairment question? So let's try the 2 questions all on the impairment. Then we move on to just take down. Let's see.
All right. So let's say impairment. Question number 1. B Limited operates a factory as its sole cash generating unit. During the year 30th April 2020, there was an explosion in the factory which necessitated an impairment review. The carrying amounts of the factory assets were as follows. We have goodwill.
Forget about that one.
Okay. Additional information 1. An impairment review revealed a net selling price of 19,200,000, value in use of 31,200,000 for the factory. 2. Half of the machinery have been destroyed and have no resale value. 3. The patents have been suspended and are now considered worthless. 4. The company follows the cost model as stated by IAS 16 DPE required. Discuss with suitable calculation how any impairment loss in the cash generation unit would be accounted for in accordance with IAS 36 impairment capacity.
Okay, so let's come here. A very simple one, but interesting. Okay, so sometimes I feel like if I bring the questions to you, it's no good. It's not good to be stressing your head. Okay, but let's come here. So at the date of the impairment, what are they carrying out the impairment test? 30th April, isn't it?
Yes, sir.
Okay, at that day we have to determine the carrying value of the assets and then the recoverable amount. And over here, the recoverable amount will be what?
31,200.
Okay, that will be the value in use, isn't it?
Yes, sir.
Yes, sir. So let's determine the carrying value of the asset. We have been given the carrying value already, isn't it? So we have 36, question 1. Okay, what is the carrying value? Question 1.
47,000.
So we have carrying value of the asset. So let's look at, so I'll just do impairment loss over here. So I'll just write impairment loss over here. Okay, the impairment loss, we have what? The carrying value of how much?
47,600.
Okay, 3 zeros at the top, isn't it?
Yes, sir.
Okay, the recoverable amount is what?
31,000.
31,200.
Yes, sir.
Okay, so 31,200. What is the difference?
16,400.
16,400. So the impairment is 16,400, isn't it?
Right, sir.
Okay. This is how we are going to be sharing the impairment now. This is how we are going to be sharing the impairment. The first item should take it is what?
The patents.
The
patents.
The patent is now considered to be worthless, isn't it?
Yes, sir.
So if this is a cash generating unit, what we do is the physically damaged asset will be the first one to take it. Then the second one will be what? Will be the goodwill. Then we now, if there's any issue of pro rata, we pro rata. But let's come to this one. Pro rata might not be appropriate over here. So let's come to allocation of the impairment loss. Is that correct? Okay. So the
Yes,
first
sir.
thing that will take it is patent. How much is the patent? The patent is now
3,600.
So patent will take all of them. So if we have allocated 3,600 to patent, what will be the value remaining?
12,800.
Okay, goodwill will take what? 2,000. How much will be left? How much will be left?
9,800.
9,800, isn't it?
Yes, sir.
Okay, let's come here. They are saying that half of the machinery has been destroyed and have no what?
Resale value.
Okay, so it means that the machinery is also what? It's also suffering impairment of what?
It's impaired.
Of how much?
By 2,000.
Okay, so machinery will now be taking 2,000.
Oh, let me see, where is the machinery value?
So machinery will now have 1/2 multiplied by 4,000. And that will give us 2,000. Then what will be left? What will be the impairment figure left? What will be the remaining impairment figure?
8,800.
8,000.
800.
800. So this 8,800, how do we go about it? How do we go about it?
We prorate it.
To which assets?
The remaining assets based on their total value.
And what is the name of those assets?
The premises.
Premises and computer equipment.
Machinery itself.
Computer and premises.
Charles, why do you think the machinery has to be impaired?
Oh, sorry, I just remembered.
Machinery house.
No, you can also assume like that the remaining one has also impaired, no problem. But the assumption is that the only part of the machine that has impaired is the half of them. The remaining one, they can still be sold at their carrying value. So the only portion of
the machinery have been okay.
2,000.
So half will get share of the.
No, the half, we assume that the half has not impaired. The only impairment is the 2,000. So the only
So the
impairment.
we have to factor the 2,000 in the 8,800 here.
No, we don't have to factor that one again. The only part of the impairment the only part of the machine that has impaired is the 2,000 that we have taken already. So the remaining one is assumed not to impair. Okay, so we have done the impairment of the machine already, which is 2,000. Okay, we have done the impairment of the machinery already. They have taken their share of 2,000. So the remaining 8,800 will be given to this asset. That will be 38,000. So we have computer to be what?
8,000 over 38 times.
So we have the computer to be 8,000 over 38 multiplied by 8,800. How that is cool. So we have premises to be 30,000 over 38,000 multiplied by 8,800. What is the figure that we are getting?
I have 1852.63 for computer. 1852.63.
Okay. So 1852.63.6. Okay, the second one will give us what?
852.63.
6947.
All right.
7 point what?
7333.33.
Okay. So can we say this will be 0.3 here?
Yeah.
So that will be giving us 16,000 what? 400. This is based on assumption that the remaining value of the equipment, the machinery has not impaired, isn't it?
Yes, sir.
Okay. So you can also do the other part and say, okay, the 2,000 has impaired, but you are still going to be impairing the what? The remaining 2,000 again. You can do that too. Okay. This one, they are not clear about it. The machinery we have charged what? 2,000 on it already. Someone can assume that it is a 2,000 of the what? The machine that has impaired. So the remaining one will not impair again. The remaining one will not impair again. Okay. The remaining one will not impair again. Someone can also say, okay, 2,000 has impaired, and the remaining 1,000 will also impair again. And this is how the person will be sharing that particular one. So we have the allocation of impairments. We'll now be having this particular figure. So you have the patent is worthless. So 3,600 will go. Then you still have the goodwill. 2,000 will go. Then you have machinery. Machinery we have of 4,000. The 2,000 will go. But someone will still bring the machinery here as a 2,000, or he will say the 2,000 of the machinery has impaired already. That 2,000 is gone, is damaged, so it's gone. But the remaining 2,000 also, there is an impairment on them again. So someone will say 2 over 40 multiplied by 8,800. How that is okay?
Yes.
Then we'll have computers. Okay, we'll have computers to be 8 over 40 multiplied by 8,800. Then we now have premises to be 8 over 40. That will be 8,800. What are we having for each of them?
You have 440 for machinery.
440.
You have 96,800 for The second one, computers.
9.
Okay.
I'm having. Oh, this should be 30 rather. Okay, so 30.
1760.
Okay. So the last one, you said
30 divided by 40.
6,600.
600.
Okay.
6,600.
Okay. So that is it. All right. So the equipment the machinery has impaired by 2,000. We can assume that it's only that portion of the machinery that has impaired. Okay, that assumption is correct. The second,
Senior,
yes, yeah.
when doing this, is it advisable to put down your assumption?
Yes,
The basis on which you are doing it.
Yeah, the examiner most of the times they will say if the student assume most especially in financial management, they will say if the student assume that this rate is this one, that is the figure. Okay. So we cannot have equipment that will be damaged. Okay. Why are you carrying out the impairment on the equipment in the first place, in the machinery on the first place? It's because of the damages that has been caused, isn't it? And you have taken the damaged ones already. It means that the remaining one will be effective. Okay. So there's no problem with that. But what you have to do is that at the end of every workings, you have to show the carrying value of the impairment after the what? The carrying value of the asset after the impairment. In total, we are taking 16,400 to profit or loss. Then, what will be the carrying value of the asset after impairment? You always have to show that. You always have to show that particular one. You always have to show the carrying value of the asset after the what? After the impairment. Is a very important one that you have to what? You have to do. Okay. The company follow cost model. So that what they are trying to say is that there is no what? There is no revaluation surplus that you are going to be writing the impairments against. Just question number 2. Okay. Very important one. Let's see.
Okay, so question number 2.
Yeah.
Raj Shahi Limited, RSL, acquired a machinery on 1st January 2019 for 480 million. RSL uses cost model for subsequent measurement, shades the machinery on a straight line basis over its estimated useful life of 8 years. At the end of year 2021, the machinery had undergone an impairment review and was consequently impaired by 40 million. At the end of year 2023, the machinery underwent another impairment review, and the following estimates related to machinery were made on 31st December 2023. So, as we have it, the machinery can be sold in its current condition for net proceeds of 135 million. However, this amount is expected to decrease by 45 million with the passing of each year. 2. Income tax is payable at 30%. 3. The applicable discount rate is 12% per annum.
Okay, let me go down for you, isn't it?
Yes, sir. Required. Compute the impairment loss, if any, in the value of the machinery to be recognized on 31st December 2023. Show all workings.
Okay, so the first one, please. You see this thing that they are giving you over here, don't be excited. Although they have given you the first impairment value, isn't it? Okay, to be 40 million. But what you have to do is that what is the carrying value of the assets at the what? At the time of you are carrying out the next impairment. So what you have to do is that at the end of 2021, what should be the carrying value of the assets? The asset was purchased on what? On 1st January 2019 for 480, isn't it?
Yes, sir.
Okay. So we are doing the first impairment at what? At the end of 2021, isn't it?
Yes, sir.
So let's come to the question number 2. Okay, and now this one. Okay. So we look at the purchase date. So the asset was purchased on, so acquisition date. Acquisition date was January 1, 2019. The cost of the asset was what? 480 million. And the useful life was 8 years as at that date, isn't it?
Yes, sir.
Okay. So let's come here. Our first impairment was carried on what? 31 December 2021. That is at the end of 2021, isn't it?
Yes, sir.
What will be the carrying value as at that date? The carrying value will be the cost minus the accumulated depreciation. From 2019 up to the end of December 2021, how many years is that?
3 years.
Okay, that will be 3 years. So we are going to be having 480 million. How that is correct? Minus what? 480 divided by 8 multiplied by 3. Is that confirmed?
Yes, sir.
So 480 minus what?
120. 180, sorry.
180. How much are we going to be having?
300.
300. And they are saying that the impairment loss on this date is what?
40.
So if the impairment is 40, what would have been the recoverable amount of the asset as at this date?
260.
2
260.
Okay. So that will be 260 a minute. Okay. So the recoverable amount will be 260, isn't it?
Yes, sir.
Okay. So we have the recoverable amount because impairment is calculated as a carrying value minus what? The recoverable amount. So if the carrying value is 300 and the impairment is 40, so what figure are we subtracting from the carrying value before getting that? So that will give us the 300 minus what? 40, isn't it? And that will
Yes, sir.
give us 260. Okay. When are we carrying out the next impairment?
At the end of 2023.
So from 2021 to 2023, how many years is that?
2 years.
Are you sure? Okay, that will be 2 years, 2022 and 2023, isn't it?
Yes, sir.
So what will be the carrying value as at that date? We have to do the carrying value. So at 31 December 2023, what will be the carrying value? Can we say that the carrying value will be 260 minus what? 260 over 5 multiplied by 2. Is that confirmed?
Yes, sir.
Okay, from the date of the impairment, the carrying value of the asset will now be the recoverable amount because we have reduced the value of the asset by 40. So we now be having carrying value 260 minus, what are we having for that?
104.
104. Okay. So the carrying value will give us how much?
156.
156. Okay. So that will give us 156. So what do we have to do at this date? We have to determine the recoverable amount, isn't it?
Yes, sir.
Okay. So determine the recoverable amount is the problem now. So recoverable amount will be the higher of the net realizable value or the value in use. Let me show you the net realizable value here before we come to this particular one. Okay, however, the machinery can be sold in its current condition for net proceeds of 135 million. Okay, however, this amount is expected to decrease by 45 million with the passing of each year. So what is the net realizable value of the asset now, as of today?
135 million.
135.
That is it. So that is what they are saying there. 135 million. So the net realizable value as of today is the net process, and that will give us 135 million. Okay. That will give us 135 million. Okay. But we also have information that we can use to calculate what? The value in use, isn't it? Okay.
Yes, sir.
Let's come to the value in use. We say the value in use should be cash flows, isn't it?
Yes, sir.
The present value of the future what? Cash flows. So let's come here. At the end of year 2023, the machinery underwent another impairment review, and the following estimate related to the machine were made on 31 December 2023. Revenues. The revenue that they are giving to you over there is what? Revenues. The assumption is that is what? Is a total revenue, which is both credit and what?
And cash.
Okay, but we are only interested in the cash revenue. Please note from today that if we are determining the value in use, we use cash flows. We use cash. We use cash flows. Okay, not just a non-cash items. Credit sales is a non-cash item, so we don't use non-cash item. So what are we going to be using over here? Our cash inflow will be receipt from what? Will be receipt from
customs.
That is the actual cash that we are receiving. So our cash flow over here, our value in use. So let's determine our value in use. Our value in use now will be determined like this. So we have 224. Cash flows are assumed to arise in what? At the end of every year, isn't it? So if you are doing this at the end of 2023, you have to use cash flows that are going to be arising a year from now, which will be 2024. So even if you are giving 2023 figure, please ignore. We estimate cash flows that are going to be arising a year from now. So if you are doing this at the beginning of 2023, then a year from now will be the end of 2023. But if you are doing this at the end of 2023 now, please, this will be the cash flow that you are going to be using will be in 2024, because a year from now is 2024. So even if you are giving 2022 and 2023, you have to ignore. Those are sunk costs. They are cash flows that have arisen in the past. Okay. They are cash flows that are not going to be arising from a continual use of the asset. We are interested in the amount that we are going to be receiving. The cash flow that will be arising from a continual use of the asset. 2023, you have already used the asset. But what will be the cash flow that are going to be arising from a continual use of the asset over each useful life? That's what we look at. So we have the 2024 and we have the 2026. So we have the cash receipts from the customers to be the cash inflows. How much are we having? Okay, how much are we having in the 2024 year?
122.
122, 134, and 124, isn't it?
Yes, sir.
So 122, 134, and 124. What will be the outflow?
The operating
56.
Okay, the operating expenses. Are we going to be using just operating expenses or the amount that has been paid?
The amount that has been paid, the cash outflows.
So we have the amount that has been paid for the operating expenses. So operating expenses, the first year will be 56. What again?
66.
66. And what
78.
again? 78. Would there be any cash outflow or cash inflow? What about interest, repayment of the loan acquired for acquisition of the machinery? What about the principal payments? What about the principal payment, the repayment of the loan acquired for the acquisition of the machinery? Principal, we are paying the principal in 2024, 20, 2025, 15, interest 6, 2025, 4. Would these ones affect the cash flow? Just, I want an answer.
Say no.
Why? For the principal or for the interest?
So for the interest,
So what about the principal?
you see, the principal is the amount we spent to buy this asset in the first place.
Just
So
you know what will happen? You see, you take your time to explain, sir. At the end of the day, then you'll be wrong. So what about the principal? Yes or no? Is it going to be part of the cash? Because at the end of the day, whatever you are explaining will be yes, yes or no. So even if you are wrong, the explanation will not do anything. So would the principal be part of it, Charles? Or you still want to explain? So explain.
oh no, sir. So yes, the principal will be part of it, sir.
Okay, so even if you explain after the end of the day, I will say no. Okay. So you
Yes,
just have to save your energy and we move on. Yes or no? Will the principal be part? You are saying yes, isn't it? What about the interest?
no, sir.
Why?
These interests are loans. These interests are on the loans we spent to acquire the machine.
So is the interest not paid on the principal?
Yes, it's paid on the principal.
So if it is part of the loan, why the interest should not be part of the amount that we are going to be paying? Just I've explained why principal and the interest should not be part of what the cash flow. If you are doing this one, the time that we were doing impairment, we even solve a question where something is like this, and I've taken my time to explain that the interest, the the discount rate that we are going to be using will always be what a weighted average cost of capital, which the impact of the interest has already been incorporated in the discount factor. So we don't use the interest because the impact of the interest has already been incorporated in the discount factor because we always use WACC. How do we calculate the WACC? It is the cost of the what? Cost of the equity plus the cost of the debt. What is the cost of the debt? It is the interest. So the interest has already been incorporated in the cost of capital. The impact of the interest has already been incorporated in the what? In the principal, in the cost of capital. So we don't use interest. Whenever you see interest, please ignore. Whenever you see tax, ignore. We use pre-tax cash flows. We use pre-tax cash flows. So you ignore. The discount factor we also use is a pre-tax discount rate. So you also ignore the after-tax rate. So if you are having tax, if the question is giving you tax paid or tax to be paid, please ignore. We use pre-tax cash flow. So cash should not be part. The interest should have been taken, but the effect of the interest has already been what? Incorporated in the what? In the cost of capital. However, the principal payment is relating to an amount that is already recognized as a liability. We say that any amount that is already recognized as a liability should not be what? Should not be counted or should not be included in the cash flow. And I've made mention of provision on that day when we are doing impairment. Any amount that is already recognized as a liability, if you are counting it again, if you are including it again, it is seen to be double counting because we have already recognized the 20 million. The liability for the 20 million has already been recognized. So if you are paying the 20 million, you are paying it in a liability that has been recognized as a loan. It is going to be reducing the loan. This amount will reduce the loan. If you're using this amount to reduce the cash flow again, it means that you are treating it two times. That is a double counting. So any liability that is any amount, any cash flow, any amounts relating to a liability that is already recognized, please, we don't what? We don't include it. Because if you pay the principal will be taken from a loan that has been already recognized. And you are still taking the principal from your cash flow, your future cash flow. You are doing these two times. That is a double subtraction. So if you are doing liability that is already recognized and you are taking it again, the figure will be taken from your liability if it has been paid and is taken from the cash flow again. You are doing double counting. You are taking the same figure twice. So because of that, the principal will not be what? Will not be part. So the cash flows that we have over here is a receipt from customers and operating expense and the payment for operating expenses. Principal is relating to an item that is already treated as a liability. So if when you pay, you take it from that amount. But if you take it from the cash flow again, that is going to be double counting. You have paid somebody 20 million. You have taken it from the person's money and you are taking the same amount from our money again. You are treating that amount two times. That's double counting. So because
So please, why is the tax also not?
What is a tax not what? What is a tax not what?
Why is the tax also not included in it?
Is the tax a necessary item to generate the cash flow from the machine?
No.
So why should you want to include a tax as part of the cash flow from using the assets? The tax is paid on the benefit. So the tax is not a cost, it's not a necessary part, or it's not a cost that you have to incur to generate the revenue. We use costs that you have to incur to generate the revenue.
Okay.
Okay. And we use pre-tax cash flows. We use pre-tax cash flows. Okay.
Okay.
We use pre-tax cash flows. So we don't use the tax as part of them. We only take into consideration the cost that you have to incur to generate the revenue. So just over here we have only two cash flows. We have only two issues: receipt from customers and payment for operating expenses. However, you are going to be having residual value somewhere. What will be the residual value of the asset at the end of the what? Of the 2026? It is 135, which is reducing every year by 45. So 2024, the value reduced by 45.
95.
Okay. So that will reduce by 2024. 2025, it will reduce.
19,
2026, it will reduce. What are we having?
45. 45.
That will be 0.
35. 45.
0.
So
Zero.
there will not be any residual value on that, isn't it?
Yes, sir.
Okay. So that will not be included because 2024, 30, 45. So it means that all of them, we are going to be selling the asset, or we are not going to be selling the asset at the end of the useful life. Okay. I was thinking there should be some value left over there. So let's come here. What will be our cash issues now? 122 minus 56. What are we having?
66.
66. Okay. 134 minus what?
68.
Okay, that will give us 68. And this will give us what?
46.
46.
Okay, this will be discounted at what? 46. At the discount factor given to you. That is 12%. Okay. So let's find the discount factor one by one now. 12%. Okay. So the first year, 1 over 1.12. What are we having?
0.893.
Okay, 0.893. The second year will give us what?
0.797.
0.797.
0.712.
0. Okay, so this one, let me do it over here. 0.712. Okay, so what are the cash flows? The 2024 is what? 66 multiplied by that. What are we having?
58.9.
We have 58.9. Then the second one is 68 multiplied by 0.797.
54.2.
54.1.
Can we say 54.2?
Yes, sir.
Yeah.
Okay, and the last one will give us what? 0.12.
32.75.
Okay, or 32.8.
Okay.
Okay. So if you put all of them together, what are we having? What is the value in use?
145.9.
Okay, 145.9 million. So what was the carrying value? The carrying value as at this date is 156, isn't it?
156.
So there will be a further impairment loss again, isn't it? And that will be 156 minus 145.9. What are we having?
10.1.
10 points.
1.
Okay, so there will be a further impairment loss of 10.1. A very interesting, very, very simple. Okay, we have 14. Please let me solve one question on deferred tax. Okay, let's solve a new question on deferred tax. Government grants, we have solved all the 2 questions already. Okay, non-current asset held for sale, we have solved that question, that AEDUSC question already. The effect of the exchange rate, we can try that one. Borrowing cost, investment property, the PP over here, but we can actually arrange and come and discuss some of them. But let me solve this question on income tax for you. Okay. Oh, we are almost done, crowd. So PP, investment property, the borrowing cost, effect of exchange rate. Is that I didn't include this thing. What are the
Tax is
standards?
there.
What are the standards that we didn't include?
Income tax is there.
Yeah, I've seen it. What are the standards that we didn't include over here? Borrowing cost.
It's 37.
37 is not here. Oh, 38 is here. Hey, 37 par. Okay, maybe I'll set some question on 37 and share with you. Okay. It's only 37. Forget about inventory and those ones. Inventory and event affairs.
Borrowing cost,
Borrowing cost is here.
government grants,
Government grant is here.
they are all here.
Yeah.
Oh, so,
37. I'm sure it's only 37. 38 is here.
investment property,
No, current asset for sale is here. PP is here. Income tax is here. The effect, the 8 is also not here.
grant is not here.
IS8 is not here, isn't it?
Yes, sir.
Okay, IS8 is not here. Okay. Okay, the 8 there, it will be, if they want to ask you, it will be theory question. Okay. Let me try. In one way or the other, I've solved all these questions before, but just that I've solved them in different classes. Okay, let's come to this income tax question. It's a very interesting one. Just pick this one. Let's use this one as the last one.
Okay, so IAS 12 income taxes.
Okay.
1. On 30th June 2022, Fora Limited had a credit balance on its deferred tax account of 1,340,600 Ghana cedis, all in respect of differences between depreciation and capital allowances. During the year ended 30th June 2023, the following transactions took place. 1. 45 million Ghana cedis was charged against profits in respect of depreciation. The tax computation showed capital allowances of 50 million. 2. Interest receivable of 50,000 Ghana cedis was reflected in profits for the period. However, only 45,000 of interest was actually received during the year. Interest is not taxed until received. 3. Interest payable of 32,000 cedis was treated as an expense for the period. However, only 28,000 of interest was actually paid during the year. Interest is not an allowable expense for tax purposes until it is paid. 4. During the year, Ora Limited incurred development cost of 500,600 Ghana cedis, which it has capitalized. Sorry. Development costs are an allowable expense for tax purposes in the period in which they are paid. Land and building with a net book value of 4,900,500 and 500
were valued at 6 million Ghana cedis. The tax rate is 30%. Fora Limited has a right to offset deferred tax assets and deferred tax liabilities, so required. Determine the deferred tax liability on 30th June 2023.
Okay. So you can see that it's a very simple question, isn't it? Is it not simple? Just after reading the question, what do you think?
Say it's manageable.
Okay, so manage it. What do you think we have to do, Charles, if it is manageable?
I'll try my hands on it, sir.
So tell us what we should do. What do you think we have to do now? What are they asking you to do? They are asking you to determine what? They are asking you to determine what? Charles, what is the requirement?
Oh, God.
Charles, what is the requirement? Charles, what are they asking us to do?
They said we should calculate the deferred tax
Liability, isn't it?
Yes.
How do we determine deferred tax liability? How do we calculate deferred tax liability?
So we look at the movement in the deferred tax payments.
Are you sure?
When the tax base
When
is
the carrying value is higher than the tax base.
lower than the carrying amount.
I'm not hearing what you are saying. No.
When the carrying value of the asset is higher than the tax base, it creates liability.
So how do we determine deferred tax? How is deferred tax calculated? Deferred tax liability or asset, how is it calculated?
It's on the temporary differences. Temporary differences.
So how do you determine the temporary difference now?
We look at the tax base and then the carrying amounts and the differences between that.
Okay. It's not only the what causes temporary difference is not only the carrying value or it's not only depreciation. A lot of things can cause what? Temporary difference. Anything that is allowable for tax purposes, but it to be for a different period can create what we call what? A temporary difference. So we'll be looking at this one by one now. Okay. So just we'll be calculating our temporary difference. Okay, let's come here. On 30th June, the Fora Limited had a credit balance on each deferred tax account of what? 1,340,600 in respect of all differences between depreciation and what?
And the capital
allowances. So it means that they are saying that on 30th June, the opening balance is what? Is that particular figure, isn't it?
Yes, sir.
Yeah.
Okay. So during the year ended 30th June, the following transactions took place. 45 million was charged against profit in respect of depreciation. The tax computation showed capital allowance of what? 50. What is happening there? The tax authority is giving us 5 million in excess, isn't it?
Yes, sir.
And the entity is enjoying the 5 million now. In the future, this 5 million will not be there. So the first temporary difference is the issue of the difference between the carrying value. So we say that the temporary difference can also be calculated using the what? The profit or loss side. And we have demonstrated that particular one when we are solving one question where the temporary difference was 75,000. Okay. So you calculate your temporary difference. Very important. So what will be our temporary difference over here? So we look at the temporary difference. Okay. Temporary differences. So we look at that one now. Those that will be an asset, you treat them as an asset. Those that will not be as an asset, you treat them as what? You treat them as a reduction. So if it is a liability, you put it as a liability. But if it is what? If it is going to be an asset, then you net it against what? Against the liability, then you just apply it on the remaining amount. Or we can calculate the deferred tax on each of the item one by one and put them together. Anyhow you want to do it, there's no problem. Okay, so we'll be looking at, so let me do it. Let me use two ways of doing this one. So we can actually have our computation of deferred tax. Okay, so we do it one by one. Those are assets we subtract, those are liability. So computation of deferred tax for this particular year. So deferred tax. Okay, so let's come here. The first one will be as a result of what? The difference between the depreciation and what? Okay, so you can have PPE. The difference over there is what? Is 5,000, isn't it?
Yes, sir.
Okay, that is going to be creating what? You can see that if the depreciation over here is lower than the capital allowance, so that means that the carrying value of the asset will automatically be higher than the tax base by what? By the difference, because 50 million will be taken from the tax base and 45 will be taken away from what? From the carrying value. So it means that the carrying value of the asset will be higher than this one. So this one, you just do depreciation, or let me just use PP over there. Okay, PP, that will give us, what is the tax rate?
30%.
So we have 0.3 multiplied by 5,000, 5 million. So that will be a deferred tax liability. How much are you having? Zero point 0.3 multiplied by 5,000.
1,500.
Okay.
1.5 million.
So that will be a deferred tax liability. So we make it positive. Okay. We make all the deferred tax liability positive, and the asset will be a reduction. So that is the first one, deferred tax created by that one. Let's count to this one. Interest receivable of 50,000 was reflected in profit for the period. However, only 45,000 of interest was actually received during the year. Interest is not taxable until what? Until received. Okay, so what will happen here? What will happen here? Just what is going to happen here? The tax authority, this is interest receivable, isn't it?
Yes, sir.
Yeah.
This is an income to the company, isn't it?
Yes.
Okay. What will happen is that you are including 50,000, but the tax authority will charge tax on only what?
Only 45,000.
Only 45,000, isn't it?
Yes, sir.
Okay. What it means is that the tax base of the interest will be 45,000. The tax base of the
Yes,
tax
sir.
base of the interest will be 45,000, but the
Yes, sir.
carrying value in the books of the entity will be 50,000. Okay, you can see that the carrying value is higher than the tax base by 5,000. This is an interest. The tax authority will charge interest of what? Will charge tax on only the 45,000. You are going to be paying what? Tax on the remaining 5,000 when it is being received. So will this particular one be a deferred tax asset or deferred tax liability?
It creates liability.
Okay, so this one you have the possibility you are going to be paying interest on the 5,000 whenever it is being received. This is interest received. If it should be interest expense, then that will now be an asset to you. So we have the interest over here, which is the interest receivable. Okay, interest receivable is going to be creating a deferred tax. We are going to be paying interest on this. So 0.3 multiplied by 5,000. That will also be 1,500 as a liability. I hope that is okay.
Yeah.
Okay. Let's count to the next one. Interest payable of 32,000 was treated as an expense for the period. However, only 28,000 was actually paid during the year. Interest is not allowable for tax purposes until it is paid. So we are subtracting 32,000. The tax authority is giving us capital allowance on only 28,000, isn't it? This is
Yes.
interest is a liability, isn't it?
So we still have liability of the difference.
So
Which is it?
no, this will not be a liability. If we pay the interest, we are going to be enjoying the tax what? The tax
Okay,
benefit.
okay.
So this will be a deferred tax asset to us. I hope that is cool.
Yeah.
Okay. So we are going to be receiving, we have paid only 28,000. How much are we going to be paying in the future?
The difference is 4.
Is it 4,000 or 6,000?
4,000.
Okay. So if this amount is paid, the tax authority will give us tax benefit of what? 0.3. How much are we getting? I'm having 1,200.
Yeah, 1,002.
That will be a deferred tax asset. So we subtract. Okay. Let's come here. During the year, Fora incurred development cost of what? 500,000 and 600, which it has capitalized. Development costs are allowable for tax purposes in the period in which they are paid. So what happened is that they have capitalized this amount, but the tax authority has charged charged all this amount against their profit, which tax has been paid. This is an asset. So it means that the carrying value of the development cost is what? Is 50,600, but the tax base is 0. The tax base is what? Is 0 because the tax authority has given the capital allowance on the full amount. So the development cost will always bring a deferred tax issue because the tax authority has given you. So you have the development cost. The tax authority has given you that one as capital allowance, but you are capitalizing it. It means that in the future, this particular amount will not be available for you to deduct from tax. So you suffer the tax benefit on the amount that you have enjoyed now in the future. So that will be 600. How much are we getting? Sometimes they will give you this figure and you have to amortize and get a remaining figure. So 0.3 multiplied by 500, 600. What are we having?
150, 180, 150,000. 180.
Okay. That will be a liability. Okay. Land and building with a net book value of 4,990,500 were revalued to 6 million. The tax rate is this one. If there's a revaluation, the revaluation will automatically increase the carrying value. Okay. So what is the difference there? The fair tax relating to revaluation. What is the difference? What is the revaluation surplus?
So it's the figure is on wheel.
So we have 600, 6 million
900
minus 500. I'm having
109,500.
Okay, is so 109,500, isn't it?
Yeah.
That will be creating deferred tax liability. How much are we having? 32,9850. So what is our total deferred tax liability?
9,850 plus 151 plus 3,000 minus 1,200. 140. Am I correct?
I'm having 4,810.
I'm having 481,830.
Yes, please. So
Am I correct?
Yes, please. 481,1830. So that is a deferred tax. Very simple one, just it's not difficult. Okay. Yeah. So that is it. Yeah. So tomorrow we look at final accounts and some theory issues. Okay. If there are no issues, Have a good night and go through the rest. All right. Thank you all for coming, and I will see you guys.
Thank you, sir.
All right.